All-important US inflation print, the final piece of the economic jigsaw before tomorrow's Fed decision. Surprise stimulus. Bloomberg understands that China is considering a broad range of measures, including support for the real estate market. It follows an unexpected cut to a short-term interest rate. Plus, the UK labour market unexpectedly tightens with a surge in wages, increasing the inflationary pressure on the Bank of England. The pound is higher this morning. We'll be checking in on gilts when they start trading just in the next few seconds. Here's a look at the futures then, pointing to gains of 0.7%. A reminder that the Nasdaq and the S&P stateside ending at highs last seen in April of 2022. And yes, it is that tech-fueled rally that was in focus for the Nasdaq, gaining around 1.75% by the end of the close. Oracle, a key factor in that. The FTSE 100 currently up just 0.1%. That surprise then, the jobless rate here, just 3.8%. The expectations that you're going to get further hikes from the Bank of England through the summer. June the 22nd is the next meeting, 25 basis points baked in. That is the expectation, but the pressure in terms of the BOE in that response as you go through the summer, the pound rallying again on the back of that surprise data around wages up and that jobless rate down to 3.8%. The FTSE 100 gaining 0.2%. Over in France, the picture is a little brighter, gaining 0.5%, adding 40 points so far in the session. The Spanish IBEX currently flat. Let's switch it on and just reflect on the China session, the Asia session. The upside coming through for tech, of course, the handoff from the likes of Oracle and that further gain coming through from the Nasdaq, but also that stimulus, the 7-day repo rate being cut, but then the Bloomberg scoop around broader stimulus coming through and gains there for HS Tech of 2.5%. Futures in the US pointing to further upside of around 0.2%. There's the pound upside then gaining 0.4% in the session today. 125 if you hold above these levels and think about the next steps for the BOE. Here's the gilt move then, 3 basis points, 467 at the front end. And that is a picture again of yields edging up at the front end in terms of UK gilts. That's the 2-year 467, the 10-year, by the way, 438. The pricing hasn't quite reflected the 10-year, the 30-year 458. Again, on that surprise around jobs, 3.8% and wages up. To China now, said to be considering a broad package of stimulus measures, as I mentioned, as pressure builds on the government to boost the economy. It comes as the PBOC surprised most economists and market participants by cutting a short-term policy interest rate. Joining me now is Marcus Morris-Ayton, European Equity Portfolio Manager at Allianz Global Investors. Marcus, good morning. Thanks for joining us in the studio. Let's start with the news out of China then. And as well as that rate cut, we have reporting from our own team on the ground in Beijing, sources that they're speaking to saying that policymakers are now considering broad measures to support real estate and, importantly, I think, to support domestic demand. How do you think about that in terms of how you position either around Chinese equities or maybe more importantly for you, the linkages to European stocks?
Yeah, absolutely, and it's very welcome news, and you can see, as you said, markets rallying off the back of that news. I don't think it's totally unexpected because a lot of data we've been receiving from China in recent weeks and months has perhaps been weaker than investors hoped. And when China opened, you saw a recovery in domestic consumption, particularly around luxury goods stocks, etc. But actually, it was less broad-based than we probably saw when the Western economies opened up post-COVID. And from speaking to companies, what you've seen very much is many companies having to rethink their Chinese supply chains. So a lot of companies are now doing China for China and potentially diversifying some of their manufacturing outside China. And you've seen that in the export data from China. So I think this move is certainly positive, but we'll have to see how it manifests and whether it properly materialises.
How do you want to play it? How do you want to lean into that stimulus? Do you want to lean into those European stocks like luxury, like the automakers who have that big exposure to China? Or would you talk to your Asia team about maybe buying up A shares, 8 shares on the back of this?
Yeah, so, I mean, luxury is probably the highest beta way to play that. And we saw that post the COVID recovery. It recovered quickest.
Has it got further to run? It's come off a little bit, luxury.
It has come off. And the issue with luxury is not necessarily what's happening in China. It's what's happening in the Western world. And you've seen domestic consumption slowing, particularly on the consumer side in the US. And actually what we've seen is many of the luxury companies gradually raising prices, but not to the extent they have in the previous years. And actually, if you look at LVMH, they've avoided raising prices in the US this year. So that's probably an indication of some softness in consumer demand in the US at the moment.
To the US then, we have a warning from a one-time bull, JP Morgan's Marco Kolanovic, saying that, actually the upside that we're seeing doesn't have much further to run. Again, just to reflect on the fact that NASDAQ and the S&P closed at April 2022 highs, or the highest level since April 2022, I should say, yesterday. A warning there from JP Morgan around the vulnerability or the fragility around this rally. Do you think it has further to run? Are the catalysts there, or are we overpricing a Fed pause scenario?
It's a good question. I think many investors are surprised to where we are now. If you look back a couple of months ago, the markets were pricing in 100% probability of a rate cut now, post the collapse of Silicon Valley Bank. And here we are today, looking at a 30% probability of a rate rise. What do we expect to see tomorrow? I think it will largely depend on the CPI data we receive later today. Assuming that isn't terrible and a big shock to markets, I think we probably see a rate pause in the US. The bigger question, though, is whether that is a temporary pause or more of a prolonged pause. Because actually, once the central banks pause, the hurdle rate to then continue hiking is typically slightly higher. So we will see, and we're watching out for Fed commentary post that. But the challenge really for central banks is getting down towards the 2% midterm target, and we're still some way off that.
How constructive are you on European equities?
Yeah, I think we are. I mean, a lot of the bear cases are gradually fading. A year ago, everyone was talking about an imminent recession. That still hasn't yet appeared. And actually where we are today is earnings estimates are 30% higher than we were a year ago. And at that point, everyone was saying earnings estimates were too high then. The energy issues hopefully look like they've passed. Inflation is cooling. And actually speaking to companies on the ground, I think companies generally are much more positive than we necessarily hear from many of the strategists.
There's a big story again around, well, just a reminder, it's a daily occurrence now around AI and the catalyst that's coming through, and Oracle is kind of front and center on that play today, given the outlook for future earnings from that company, and AI clearly consequential for them around cloud computing. How do you think about adjusting, or at least positioning around AI? There's the hype and then there's the reality. How do you think about folding that into your portfolios?
Yeah, it's a great question. It's something that's coming up, understandably, in every company meeting we have. And similarly, every company is keen to tell you and reinforce the AI credentials.
Yeah.
Some of those are probably more realistic than others. But the challenge for us as investors is it will radically transform businesses and probably the way we live and operate. And that comes with opportunities and challenges. And so there will be a few AI winners. There will be a lot more AI losers. And there's certainly a degree of hype at the moment, and you see that in terms of NVIDIA's share price. But the opportunity for investors is really to try and understand where those opportunities lie. And it might be in areas like the semiconductor market that supply into some of those AI themes.
And more broadly, and you touched on the fact that earnings have actually surprised to the upside, that margin resilience, as you talk to corporates, you talk to businesses operating on the ground, where are you getting the sense that that margin, their ability to hold those margins is going to come through? Which sectors, which companies are best positioned in a slowing growth trajectory, even if we don't get into recession, to hold on to juicier margins?
Yeah, so inflation is, as it has been for the last year, the main topic that companies are discussing. But now they're rather discussing falling input prices and the pressure that comes with from their customer base in terms of being forced to lower prices. So what we're really looking for is companies with good pricing power that will be able to maintain prices as their input costs fall, and hopefully that translates to elevated margins. And that differs hugely by sectors and by companies within sectors. So we're generally looking for companies with good pricing power, differentiated products, whose products are integrated into their customer supply chains. And that's what gives you the pricing power to be able to maintain prices in a falling price environment.
Okay, Marcus, thank you very much. Indeed, constructive on European equities, maybe some upside coming through from the semiconductor space and the linkages there to AI. You've got to look for those companies that are able to hold on to that margin and that pricing power. Marcus Morris-Ayton, of course, European Equity Portfolio Manager at Allianz Global Investors. Coming up, what is the way forward for European banks? We get the view from Goldman Sachs' international CEO, Richard Node, in our exclusive interview. That is next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 11 minutes into the European trading day. You're seeing gains of 0.5%, risk on across these equity markets. Futures in the US also pointing to some upside, building on the gains of yesterday, up 0.2% on the S&P E-minis. The strong labour data out of the UK bolstering the pound. Currently versus US dollar, you're looking at GBP at 125. Gilts are selling off, yields up 7 basis points at the front end, 471 on the 2-year. Let's get to some conversation with Goldman Sachs, the international CEO, Richard Node, who says that the bank is seeing, quote, some green shoots that signal a pickup in IPO. Speaking exclusively to Francine Lacroix, Node also discussed the potential job cuts, market volatility, and the European banking space.
Well, to start with, they're in a much stronger place than they've been for, well, probably 15 years. And so if you look at strength of balance sheet, capital ratios, probably 3 times what they were going back to 2007. Liquidity, much, much stronger. And really the underlying strength of the balance sheet is strong. So whatever lies in front of us, I think we are in a good starting position.
Are you confident that what will be in the pipeline, so it could be M&A and IPOs, will get better rather than get worse from here?
I think we're starting to see some green shoots, in terms of IPOs. We've got a number of IPOs in the market right now. They've still got a price. Some of the IPOs done in the earlier part of the year got done but didn't trade so well afterwards, and that's obviously a key measure. So one is the pricing and then the aftermarket performance, so we'll have to watch that. There's been a lot of block activity. There's been a lot of secondary sell downs, throughout this year, and the market has absorbed those and absorbed them well. On the M&A side, corporates are certainly looking. We saw another big healthcare transaction announced this morning. The sponsor network is looking. Some things are getting done. I think the bid offer is still too wide. So from a pricing point of view, we haven't quite gotten there yet. But you can see people are looking to do things. So there's signs of activity, yes.
Do you worry that actually you're losing business, that Wall Street titans in general losing business to either smaller boutiques or brokers or even domestic banks?
No, I think we have a lot of confidence in the strength of our M&A franchise, and it's really built on, well, first, a hugely experienced team across geographies, across industrial sectors. People who've been in the business for a very, very long period of time, and it is an experience-based business. And being able to connect the dots on a global basis, and I think that's become, if anything, more and more important. So there's that component to it. And then the financing component, and being able to bring the full package. And it's one thing knowing what you want to do, it's another thing being able to finance what you want to do, and we can help on all fronts. And no, so I think we feel good about our franchise, but it comes down to client relationships, being part of that intimate dialogue, and certainly from where I sit, I see that as strong as ever.
Are you done with job cuts?
Well, we right now, as we disclosed last week, going through a process for a small number of people, 250, thereabouts. We obviously had a more significant exercise at the beginning of the year, and that's all in response to our perception that markets were going to slow down. They certainly have slowed down, and some ongoing weakness across markets. And so we want to make sure that the firm is right-sized. The reason that this exercise is very targeted and small is that we're really targeting those parts of the business which are slowing down. Not all parts of the business are slowing down.
And that was Goldman Sachs International CEO Richard Nodde speaking exclusively to Bloomberg's Francine Lacqua. Coming up, what are some of the risks and what are some of the rewards of artificial intelligence? I spoke to the CEO of Google DeepMind about this and much more in our exclusive interview. That is next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
It's really important that we try and understand the importance of not just AI, but other innovation coming in the tech sector, not be scared of innovation. Innovation is good. What innovators want is some certainty. They want to know what the rules of the game are. They often want, regulation, small r, and sometimes big R as well.
Mayor of London, Sadiq Khan, speaking to us about the opportunities in AI at London Tech Week. And Google DeepMind CEO and co-founder Demis Hassabis says governments should prioritise increased investment in AI safety research to mitigate risks. Speaking exclusively to me, Hassabis also talked about the potential impact that AI may have in the scientific and medical fields.
I think there are three different types of, broadly speaking, buckets of risk. I think number one is bad actors using these dual-purpose technologies in ways that are bad for society. I think that's true of any new transformative technology down the years, so I think AI is no different, other than the fact that it's maybe the most general type of technology. So that becomes a question of access to these technologies, and that's what needs to be thought about there. I think the second one is near-term use cases where things like deep fakes or disinformation or bias in our systems that can affect near-term products and applications that we see today. And I think that has to be mitigated by some new technologies, things like watermarking, and so you can detect deep fakes, but also existing regulation being beefed up in areas like health or transport to deal with the coming new wave of AI, just like we did with the internet and mobile. And then finally, there are these longer-term technical AI risks that I think more research is required to understand them better, understand these systems, where they're going, to allow us to sort of figure out what the bounds are of what these systems can do, how we can control them, how do we align them to human preferences. And then once we understand those better, we can sort of, government and others, international society can sort of put the guardrails around it. So I think it's important when you're in regions of, accelerating technology, high uncertainty. Doesn't mean things are going to go wrong, but it means that we're as uncertain about what the underlying technology is going to look like in 5-10 years, then I think we should proceed with what's called the precautionary principle. So proceed with exceptional care and thought and use things like the scientific method.
You're very used to putting probabilities on things. So I just want to push you on the most extreme area and the most extreme risk. And I feel it feels hyperbolic to talk about hyperbole, to talk about potential extinction as a result of AI. But in your time, whether it's developing games or as a chess grandmaster, you know about how to put probabilities on things. What would you put the probability at of AI-linked extinction?
Well, look, I think it's I don't think no one can put a probability on these things. I think there's a huge amount of uncertainty. The probability, many of my colleagues think, is very small. But even if it's very small, one should pay attention to those things and ahead of time, not wait for those things to happen. And if you look at things even like, much less powerful things like social media of the last decade, fantastic benefits to society, many things in individuals in our social lives and so on, but also has unintended consequences, as we're now seeing. And so I would like us with AI to get ahead of those things and to be pre-prepared and to put down the guardrails, society put down the guardrails ahead of time, not after the fact. And I think it's too important in technology not to get that right. So I think all that letter was saying is we should pay attention, and I think the Prime Minister and other governments are, and I think things like the Global Summit that the Prime Minister announced in the UK, bringing together experts from around the world, from academia, from civil society, from government and from industry, to come and talk about these risks and these opportunities, and then what can be done to mitigate them. For example, come up with the right evaluation tests and benchmarks to evaluate what these systems can do and the capabilities they have, I think is the right next step. So,
for those who would say, look, even if there's just a 1 or 2% chance of a catastrophe, then just stop where you're at. What would you say to those people?
Well, as I said, we have no, at the moment there's a huge amount of uncertainty over these future technologies. Very hard to predict what's going to happen in 10, 15, 20 years' time. If you think back to 10 years ago or 15 years ago when we started DeepMind, no one thought AI was possible. No one was working on AI. When I remember when I was doing my postdoc in academia, the professors would eye roll at even the mention of AI as being something that's science fiction and not a serious subject. And look how far we've come in the last last 10, 15 years. So I think it's hard to predict things going forward. But the reason to work on AI is what we discussed at the beginning, which is the potential it has to help society with all of these challenges that we have, from disease to climate to energy. All of these things, I think, can be impacted and helped by a technology, an incredible tool like AI, helping the world's experts solve these problems.
And what would you advise governments, not just the UK government, governments around the world, to focus on, to prioritise now in terms of policies they can enact now to put some guardrails in place around this technology?
I think the number one thing that needs to be done right now is to put more investment into AI safety research and understanding what these systems can do, analysing them, interpreting them, and then coming up with things like evaluation benchmarks so that we can understand what capabilities we want and what guardrails that we therefore should have to make sure society reaps all the benefits of these systems and the incredible potential they have, and we mitigate the risks.
Last question on jobs. You have children. Would you advise, what jobs would you advise your children to steer away from because you think that in 10, 15, 20 years they're just not going to exist?
Again, I think the whole jobs question is a very complicated one to predict. As with, there's no doubt that AI is going to bring changes and disruption. But I actually think if you look at the history of these things like internet and mobile over the last 10, 20 years, they also cause huge changes. But actually, whole new categories of jobs were invented. Actually, better quality jobs, higher paid jobs, and I think that's what's going to happen again with AI. I think it's going to change the job market. But I think in the fruition, fullness of time, I think it's going to create many more higher quality and better paid opportunities than we've had in the past.
And that was Demis Hassabis, the CEO and co-founder of Google DeepMind, speaking to me at London Tech Week. Let's get the Bloomberg Business Flash now. Here's Sarah Halls in Dubai. Sarah.
Hi, Tom. Oracle's quarterly revenue topped estimates as sales increased 17% in the fiscal fourth quarter. The results signal the tech firm's cloud business is benefiting from increased demand for AI workloads. Oracle founder Larry Ellison is reaping the benefits of AI popularity, edging past Microsoft founder Bill Gates to land the number 4 spot on the Bloomberg Billionaires Index. US regulators have sued Microsoft to stop the company from completing its $69 billion acquisition of game maker Activision Blizzard. The Federal Trade Commission wants a court order blocking the deal from going through until the agency's in-house court can review it. Microsoft says it welcomes the opportunity to present its case in federal court. SoftBank-backed chip designer ARM is said to be in talks with potential investors, including Intel, to anchor what will be one of the largest IPOs of the year. Intel and ARM have already announced a technical tie-up. Our sources say ARM has held talks with other companies about participating in the offering, which could give it a valuation of up to $70 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Tom.
Sarah Halls, thank you very much indeed. And that tech story, the Oracle story, is feeding into the optimism, certainly in the tech space here in Europe. Technology is the leading sector, currently in the session gaining 1.7%. Here's a couple of names that stand out for you. SAP, of course, a software company based in Germany, gaining 1.3%. Sage, based in France, or UK, I should say, up 1.3%. And Dassault, also up around 1.2%. Again, the lift in terms of the AI optimism, Oracle at a record high, and that is filtering through to the European session. Coming up, we're going to speak with Erin Platts, the former CEO of SVB UK. We're going to discuss all things tech, as well as the fallout, of course, what it means for the new HSBC business. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are the top stories. The unstoppable NASDAQ. Tech shares fuel a global equity gain ahead of today's all-important US inflation print, the final piece of the economic jigsaw before tomorrow's Fed decision. Surprise stimulus. Bloomberg understands that China is considering a broad range of measures, including support for the real estate market. It follows an unexpected cut to a short-term interest rate. Plus, the UK labour market unexpectedly tightens with a surge in wages, increasing the inflationary pressure on the Bank of England. The pound is higher and gilts are selling off. Let's check in on these indexes then. The FTSE 100 is still up just by about 11 basis points at 7,581. But the gains are a little bit more solid when you look at the DAX gaining 0.6%, and across the European benchmark up by 2 points, gaining 0.4%. The lift that came through from the US with the NASDAQ and the S&P ending the session at highs, the highest level since April of 2022. Across your sectors, no big surprise given the lift that came through from the NASDAQ yesterday. Technology in Europe gaining 1.7%. It is leading so far in the session, followed by basic resources. Certainly copper and iron ore prices have jumped on the back of the stimulus support stories coming through from China. Basic resources gaining 1.2%. Bottom list, real estate, utilities and insurance all lower. Real estate off by a full percentage point. Let's get back to the UK story then, and the wage strength that came through. That surprise, the jobless rate at 3.8%, wages higher. The challenge then for the Bank of England, as markets expect there's going to be further hikes. June the 22nd is the next decision for the BOE, and then there's an expectation they're going to have to hike through the summer. The pain on households, particularly those looking to remortgage. 472, you are back and close to that moron premium that came through under the government and the premiership of Liz Truss. 473 is where we landed there after the tumult in the UK financial sector. At 472 now, yields up 8 basis points at the front end. Let's get to the banking story then. The Barclays CEO says leadership changes at the firm's investment bank and refocusing on new growth areas have contributed to higher than usual attrition. CS Venkatakrishnan spoke to Bloomberg's David Weston about the economic outlook and the banking landscape.
We're losing a few investment bankers, but not that much more than what is normal annual turnover. I mean, this is the period in the first few months of the second quarter when people have been paid their bonuses and there's a little bit of musical chairs, as you know. It's a time-honored tradition in this industry. We made a management change in our investment bank. We spent a lot of time last year thinking about what we expected the banking landscape to be over the next decade. So what you've seen is rising interest rates, changing business models, the importance of sectors that are fairly new to the economy, not just technology, but sustainability, mobility, climate tech. And then there is just the different players and the importance of the players in the banking market. The private equity groups have been very large. Private credit funds are becoming bigger. They're slightly disintermediating what banks are doing. And as we began with a very American investment bank here in the US, based from the Lehman acquisition of Barclays, and we've grown in Europe, we wanted to put more emphasis in Europe as well. So you bring it all together, and you're talking about us thinking about the next generation of leadership of the investment bank. Building on our strengths in debt capital markets, but growing in equities, growing in M&A, growing in Europe. And when you do that kind of organizational change, sometimes it has impacts.
Well, you suggested something I was curious about. Is there a strategic shift in emphasis in the investment bank a little bit away from the United States and toward Europe? Because as I recall, your two co-heads before were based in the United States. The two co-heads now are going to be based in Europe.
One is in Europe and one is here in the US. So it's not a shift so much as an expansion. It is to try to give more attention to Europe, relatively speaking. The US remains critically important to us. And the US businesses are some things, especially in the debt capital markets, where we are absolutely leading, and we want to maintain that position.
Barclays CEO C.S. Venkatakrishnan speaking to Bloomberg exclusively. We'll stay in the banking space now because Silicon Valley Bank UK has been rebranded as HSBC Innovation Banking and aims to help tech and life sciences businesses grow. It's going to operate in the UK, of course, as well as the US, Israel and Hong Kong. The launch comes after the lending giant bought SVB UK for £1 in March, following the collapse of the California-based parent firm. Very pleased to say, joining me now in the studio is former SVB UK CEO and now the head of the new rebranded entity, Erin Platt. Erin, thank you. And we're going to get onto the rebranding, what it means for your clients, what it means for the business opportunities going forward. But let's start with what it was like, that tumultuous period in March, when, of course, we saw essentially the run on SVB in the US and then here in the UK. When did you first get a sense that things were turning and going wrong? And what was it like to live through that moment?
Yeah, Tom, thanks for having me. You're right. The last 3 months in March was a very, very difficult period. And it was, I would say, bank run, it moved very, very quickly. So being here in the UK, we were working with some US colleagues on Thursday. Friday became, woke up Friday, opened the doors. It was a slower burn than what we saw in the US, but it was clear by Friday afternoon when the US parent was taken over by the FDIC that we would continue to see some issues here in the UK. And as you know, the SVB business focused on innovation companies. Our whole premise was to make clients' lives easier and to support them. So to be the cause of such a stressful weekend was really challenging.
Do you think, was it a case of the mothership bringing down the UK subsidiary, or are there things, as you reflect back, that you and the team could have done differently to mitigate some of the downside?
Yeah, I mean, the U.S. business was clearly under a lot of pressure on the Thursday and Friday, and given the same brand, we really did suffer from what was happening in the U.S. And we were hopeful to open the doors on Monday, given the strength of the UK business. We were a separate legal entity, but as things transpired over the weekend and the reliance on the US parent, it was clear that that wasn't the right decision. So we worked tirelessly over the weekend with the aim to make sure that we could do everything possible to allow our clients to continue to operate on Monday morning and to save as many of the jobs and our amazing employees that we could.
And obviously tangible relief across the UK tech sector, of course. You've rebranded, it was launched yesterday. You're now the head of HSBC Innovation Banking here in the UK. Talk to us about how you fit the culture, that thrusting, driving culture, that tech-focused culture of SVB into the legacy bank that is HSBC. How do you meld those two cultures?
Yeah, well, a couple of things. So we're super proud of the name HSBC Innovation Banking. That was really co-created with our clients. Early stage companies, venture-backed businesses, public and private corporates, VC and PE funds. And we purposely wanted to make it a name that would resonate globally. So UK, US, Hong Kong, Israel, Nordics, where we have teams on the ground. And it's been exceptional to see the pace and agility that HSBC has moved, not just the weekend in March, but since that date. And as Ian and Noel have been really vocal, we're going to keep the business together. We're going to keep the team together to ensure that we maintain that agility and that focus on innovation businesses, but then also bring the best of HSBC. It is incredible to see the size, scale, stability of that platform, and it's really accelerated the plans that we had in UK and Europe by at least 5 years.
Wow, okay, at least 5 years in terms of accelerating those plans. Are you actively trying to get existing HSBC technology customers to move into your part of the business? Is that something that you're working on as well?
No, we're trying to do what's right for the clients, to be honest with you. We've got a lot to do in terms of continuing to take care of the existing client base. We've seen wonderful demand, especially after yesterday launching the new brand. And if there's innovation businesses within HSBC that need a particular product or service, we'll be very, very happy to provide that through the Innovation Bank.
And you've got staff here in the UK, of course, the Nordics as well,
Yes.
Israel. Noel Quinn talking to Bloomberg yesterday saying that he's keen to expand into continental Europe, your part of the business. Do you align with that? And are you looking to add headcount? How aggressively do you want to move onto continental Europe?
Yeah, one of our, the vision and ambition, which after the last couple of days, I think has only grown to be even stronger, is we really want to be wherever there's pockets of innovation, talent, and capital. And what we're seeing from a European innovation economy perspective is a lot of strength and excitement. So over time, I think absolutely working with the team to find out where there's the pull from the clients to make sure that we can set up wherever that might be across Europe or globally. So we've got a lot to do. Day 2 of the rebrand, but watch this space.
HSBC obviously has a massive footprint in Asia, consequential for the overall group. HSBC Innovation Banking, largely a kind of Western tilt so far. Does Asia become a big play as well for that part of the business?
I think over time, absolutely. Again, Noel has been really vocal about wanting to take this business and this brand global to benefit our clients. And, starting with Hong Kong, I think makes a lot of sense. And then again, we'll see post that where else we go.
Have you had to adjust? You were banking at SVB Bank. That was part of the appeal. You were banking largely companies that were unbankable amongst other banks, and you offered that proposition. Have you had to lower your risk and adjust the risk when you look to clients? What is the proposition that you're offering them? Talk to us about the risk adjustment.
Yeah, so the innovation economy and the part of the market that we were working in was absolutely early stage, venture-backed, loss-making businesses, but also late-stage public and private corporates and VC and PE funds. And it's really important that the last 90 days, we showed the ecosystem that it's business as usual, that we haven't changed how we support them, we haven't changed the product and services, and I think our actions hopefully have spoken kind of louder than words in that we've been able to continue to offer the product services, that's banking, that's lending, as before. And I think the most exciting part about the next, hopefully 6 to 12 months, is it's going to be additive to what we've been able to do before.
Okay, Erin Platts, really excellent. Really appreciate your time. Thank you for coming to the studio. Congratulations on the rebrand, of course. Good news, largely for the tech sector in the UK. We'll see how things pan out. The opportunities there under HSBC Innovation Banking, the UK CEO, Erin Platts. Coming up, as corporate emissions lead global climate change, Watershed uses big data technology to help companies reduce their carbon footprint. This is a fascinating company with advisors including Mark Carney and Al Gore. We're going to be speaking with the co-founder, Taylor Francis. Don't miss that conversation. It's next. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You gotta be, you gotta show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't wanna do this. You gotta show up. You gotta be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Welcome back to the Open. 44 minutes into the European trading day. Gains of 0.5% across the European benchmark, led by basic resources, up 2.2% on the stimulus reports and rate cuts coming through from China. Tech also up 1.7%. The optimism coming through for the Nasdaq overnight, gaining 1.75%. Oracle doing very well in terms of forward guidance. Let's get to what's happening across the corporate space when it comes to tackling emissions. They are, of course, the leading contributor to climate change globally, according to climate platform Watershed. The company uses big data technology to reveal sources of hidden corporate emissions and help companies identify areas for removal, from office lights to the supply chain. Very pleased to say I'm joined now by Watershed co-founder Taylor Francis, and worth mentioning as well that this is a business, good morning Taylor, backed by Sequoia and Kleiner Perkins, and other really big names, and you've got advisors including Mark Carney, of course, formerly of the BOE, and Al Gore. You've got some big backers. How much demand are you seeing in an environment we're all kind of wrestling with the question of slowing growth, recession, inflationary risks? Is the demand still there for your services?
Yeah. Well, Tom, thanks for having me. And you're right, our kind of product enables companies to measure, reduce, and report their carbon emissions. And we're seeing that this is an imperative for every company. I mean, the phone has not stopped ringing in the last year and a half. I think that's driven by two things. One is that companies have an imperative to report their emissions. In the UK, in Europe, soon in the US, if you're a public company, you've got to disclose your carbon to investors the same way, with the same rigor that you disclose your financial results. That is a big deal. I think the thing that has really changed in the last year is that CEOs don't just see this as a political issue, they don't just see it as a compliance issue, they see a huge opportunity in investing in the green economy. You know, there's $1 trillion last year invested in climate technology. I think every company wants to have a part of that going forward.
Talk to us about the regulatory impulse coming through then. The SEC is expected to make a decision around mandated disclosures around emissions shortly later this year. The UK, the EU, arguably taking the front foot on this. How much of an impulse is coming through from the regulatory front?
Yeah, I think it's a big deal. You know, if you go back 10 years, companies measured their carbon emissions, but they put them in the CSR report, and they probably spent more money on the graphic designer than they spent on doing the numbers. We're in a totally different world now. If you are a UK public company, you have to report your carbon emissions to your investors, to the FCA. Next year, in the EU, the CSRD regulation is going to bring a similar level of disclosure to 10,000 public European companies. And the SEC is going to finalize a proposal in the next couple months that's going to mandate this for US public companies. And so kind of the carbon numbers are coming out of the CSR report, they're coming into the 10K, and we're seeing the level of rigor expected in your carbon numbers really increase. I think that's good news because investors get better data, companies get better visibility on where their carbon comes from.
You've got some massive names in terms of clients. You've got the likes of Walmart, you've got BlackRock, you've got Stripe, really big tech names, really big finance names, and then Walmart, of course. What's happening in terms of the energy sector, the auto sector, airlines? Are they getting on board as well, or are they slow to move on this?
I think absolutely. I actually think a lot of those sectors are some of the sectors leading the rest of the economy on this. We work with tech companies, finance companies, we work with jet manufacturers, we work with fried chicken suppliers, and the thing that we see is that in every industry, there's an opportunity, and leaders are seeing opportunities to build a climate part of their business that is where they expect the growth to come from in the next decade. I think that's really exciting.
You touched on politics very briefly. A backlash, Republican-led backlash against all things ESG. Is that a headwind to you in the business? Do you have to fight those political headwinds in the US?
I don't think companies see this as a political issue. I think that the train has left the station on carbon being a part of how you do business. If you're a global company, you've got requirements in Europe, you've got investors, you've got customers. This pressure is coming from all angles. And the companies we talk to are really kind of trying to figure out, how do we do this, not should we?
Acquisitions. You bought Vital Metrics this year. You did an acquisition. Are you looking for further acquisitions? And how are you set in terms of funding plans and the look ahead to maybe an IPO?
I think we see a lot of opportunity right now. We acquired Vital Metrics, which is the kind of database behind the best carbon data in the industry, started by the architect of carbon accounting 20 years ago. And we're trying to figure out how do we bring that data to our customers to enable them to make better decisions. We're definitely on the lookout for more ways to do that as companies realize that how you do the numbers on climate really matters.
Very briefly, you're split in terms of the headquarters between San Francisco and London. Is the UK still investable for you?
We are investing in the UK in a huge way. We early on decided to make London our dual headquarters. We expect half of our team, half of our customers, half of our revenue to come from Europe, HQ'd in London. I think the UK and Europe, but especially the UK, have been on the leading edge of climate for a long time. That makes it a great market for us. I think it makes it a great market for a lot of companies too.
Taylor Francis, thank you very much indeed. Really appreciate you coming to the studio. This is a company to watch, people, certainly going forward, making big strides in this space. Taylor Francis, of course, the co-founder and CEO of Watershed. Coming up, the Bloomberg New Economy Gateway Africa Conference. That kicks off. We are live in Marrakesh, of course, Morocco, with the details. Stay with us. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open. We are 52 minutes, almost 53 minutes into the European trading day. You're seeing some optimism across these stocks, gaining 0.4%. The action really in the bond market, the gilts, the 2-year, and the sell-off that's happening there. Yields up 9 basis points, and you are looking at the 2-year at 473. The yield rising to the highest since 2008. Again, on the tightness in this labour market, unemployment falling to 3.8%. And wages soaring, and expectations the BOE is going to have to go even further on rate hikes to tame the inflationary pressures here. Let's switch focus now. The Bloomberg New Economy Gateway in Africa, kicking off in Marrakesh. The event brings together leaders from the private and public sectors to discuss the world's most pressing issues and potential solutions. Joining me now is Bloomberg's Jennifer Zabasaja, who's on the ground for us. Jen, what are the main themes then the forum is focused on?
Yeah, Tom, I mean, you mentioned there a lot of the people who are going to be convening here, private and public sector leaders from not just across the world, but really across the continent, which I think is really key to what it is that is going to be discussed here. And when we think about some of the key points, there's a convening of leaders who are really focused on a lot of the issues facing this continent. And there's a confluence of issues, right? I mean, we have cost of living, which is, of course, something that a number of countries globally are facing. There's supply chain constraints. There's geopolitical issues. And there's a number of countries here, as we've talked about on the show a number of times, that have debt burdens, sovereign debt burdens. And so what the leaders here are going to be discussing is just how a lot of these countries can overcome that. And also on the flip side of all of that potential downside, there's also a lot of opportunity that we're seeing from private and public sector leaders. This is going to be the youngest workforce of the future. This is a continent and a region that is abundant in resources, from food to minerals. And so a lot of the discussion around over the next 2 days is going to be around what are the opportunities here and what needs to be done to really sort of address these head on and make sure that this continent is really emerging from this current global macro situation in a stable situation.
Jen, do some name dropping for us. Who are some of the leaders who are going to be in attendance?
The big, we're going to have a number of leaders. You did mention we're in Marrakesh. A number of leaders from across the Moroccan government, a number of ministers from across the continent, from Ghana to Nigeria. And also, I think what's going to be really interesting to hear this morning is we're going to be hearing from Wamkele Mene, who is the Secretary General, and he's Secretary General of the African Commission. And he is tasked with really implementing the African Continental Free Trade Area, which is going to be key for this region. Success. This is going to be really what a lot of these countries are dependent on. And so we're going to hear from him this morning specifically about what he's doing to really implement this plan. I'll also be speaking with a number of tech leaders and private sector leaders about how African countries from Nigeria to Kenya to South Africa can do what they can to really emerge as a tech success, despite what we're seeing globally. Last year, we saw a number of companies across the region really have a lot of success in their VC funding. So we'll talk about that today. So a lot to look forward to here, Tom.
Okay, good stuff. Jen Zabasaja, thank you. On the ground for us in Marrakesh. Coming up later today, we're going to hear from the UK Labour leader, Keir Starmer. He'll be talking exclusively to Bloomberg TV's Francine Lacqua at London Tech Week. That is going to be at 9:30 a.m. London time. And the polls would suggest that, at least for the moment, he is in a strong position to be the next UK Prime Minister, if those polls are right, of course. The UK, talking of that story, 472 on the UK 2-year. That's a move higher of 9 basis points. The 2-year yield did rise to its highest level in 2008, again on the hot jobs data here in the UK. Surveillance Early Edition is next. This is Bloomberg.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, and for Francine while she's at London Tech Week. Here's what's on today's program. The unstoppable NASDAQ. Tech shares fuel global equity gains ahead of today's all-important U.S. inflation print, the final piece of the economic jigsaw before tomorrow's Fed decision. Stimulus required. China said to be weighing a broad range of measures, including property support to spur growth after an unexpected cut by the PBOC to short-term interest rates. Plus, the UK labour market unexpectedly tightens with a surge in wages, putting more pressure on the Bank of England. Later this hour, an exclusive conversation with UK Labour leader Keir Starmer at London Tech Week. Let's get a look at these markets this morning. U.S. equities seem unfazed by what bond markets are seeing this morning. Both U.S. futures and European equities are moving higher. U.S. futures really fueled by the tech trade. Apple at an all-time high. Tesla on its longest winning streak on record. Oracle, a big beat and a big gain overnight. Meanwhile, you're looking at China. The yuan is trading at a 6-month low following an unexpected cut to the short-term rates. What does that mean for their MLF cut, or what's expected to be a cut later? The big mover, though, are UK gilt yields and the pound. That is rising versus the dollar. UK gilt yields now on the front end of the curve, up 10 basis points. I'll show you that chart in just a moment, but let me take you to the European map, to the overall picture of what we're seeing right now. Again, for the most part, stocks are higher, save for the IBEX. The IBEX is underperforming this morning, down about 0.4%, but most of these markets are higher, a little bit less so for UK stocks. Again, might be some of the currency effect there. But then again, back to what we're seeing in the UK. It was an unexpected hot jobs report. It was a surge in wages and unemployment dropped. What results is this. You're looking right now at the front end of the curve. UK 2-year yields, they have surpassed that Truss mini budget era high when we had that LDI crisis, but just keep in mind that was led by the long end of the curve. So not necessarily that doom and gloom here, but nonetheless, it is a much higher gilt yield now. Joining us at the moment is Laura Cooper, BlackRock Senior Macro Investment Strategist. Laura, we'll get to the UK picture in just a moment, but quickly, I want to break some news on China. Their May aggregate financing coming in at 1.5 billion yuan. The estimate was for 1.9 billion yuan. Loans were also lower, 1.3 billion yuan. The estimate was for 1.5. So I really wanted to go in on UK with you, but I just want to take a moment and pause and talk China, because we also had that cut, that unexpected cut in the short-term rates. Will this help global growth if we are starting to get some more support from policymakers in China?
I think the read across from today's surprise move is really that they're sending a signal that they're there to support the economic recovery, notably as we have seen this slowdown in the reopening momentum in China, but it's not yet seen as this injection of stimulus. So I think it's too soon to tell whether we're going to see this impulse from Chinese growth spill over to the rest of the global economy, which we still do think is going to be quite challenged through the end of the year.
Right, and I mean, here again, we have aggregate financing data, a big miss, yet another piece of China data that has missed. Is the narrative of, okay, China reopens, we get this spur in growth, is that pretty much over, or are we still waiting for a period when it does pick back up?
I don't think it's over necessarily. If we look at some of the key components of Chinese growth, the credit transmission channel has really been kind of not as what we would have expected in terms of that strong propulsion towards Chinese activity. So that could come later this year. And those policy levers at the margin could help to propel that further. But I think at this point, from a positioning perspective in portfolios, we do still like the broad EM space. China, yes, is a small component of that. Our conviction on the reopening has waned somewhat, but we do still think there's attractive opportunities in the emerging market space, given the growth dynamics, the central bank divergence in policy that we are seeing between developed markets and emerging markets.
Is there anywhere specific EM that you like, any nation specifically?
I mean, I think at this point we are waiting to see the China strength, whether that kind of resumes in the second half of the year. That will be kind of key to that. But as well, if we think about commodity exporters, yes, we've seen oil come under pressure, but there is still this structural imbalance between supply and demand. We do think that is going to really be that key tailwind for a lot of these emerging market countries, like LATAM in particular.
Okay, now finally shifting back to the UK, those pesky headlines ruining our flow here. So we do have front-end yields back at a 2008 high. You have pounds surging. Catherine Mann making comments yesterday about inflation not yet being able to rein in. Do you expect yields then to move even higher from where they are at this moment?
I don't think that's the case. If anything, I think today's move is really a knee-jerk reaction, as you mentioned at the beginning, around average earnings coming in much hotter than expected. And that really is quite problematic for the Bank of England. So the markets are reacting to the fact that we could actually see the BOE have to extend their tightening cycle. We're already seeing that June 22nd market event potentially having that 50 basis point increasingly priced in. That's certainly not our base case. But I think markets are suggesting that, look, inflation remains exceptionally elevated in the UK. That's going to be a problem, requires this tightening of policy. Our view is that we see a terminal rate closer to around that 5% mark, not that kind of 5.6, 5.7% markets are pricing. So we do think there is going to be some repricing ahead as we start to see some of that economic resiliency fade. And so that suggests there is some room to position in duration further out the gilts curve because of the market moves do appear overdone.
Okay, and what would it mean to have a Bank of England that needs to keep hiking, that kind of goes the way of the Bank of Canada and RBA if the Fed is going to pause this week?
Well, I think it's already largely in the price. If we think about what markets are expecting from the Bank of England, it's exceptionally aggressive. Where if we compare that to what we are seeing in terms of swaps pricing in the US, it's probably more in line with our expectation that yes, the Fed could have one, at most two more hikes in the pipeline, but is really the repricing will come from the Bank of England, because I think there is this risk of stagflation that's most acute in the UK versus what we are seeing in the US, where data has been resilient. There are showing some signs of inconsistency in terms of some of the labor market gauges, but ultimately we do think this is still a challenging economic backdrop for the UK, because policy rates where they are now are in quite restrictive territory, given our estimate of neutral. That is going to have spillover effects to the economic activity.
Yeah, I gotta say, Laura, I can't believe it's basically every central bank has a decision except for the BOE, and for some reason this is the most pertinent and market-moving story right now. But look, going back to the US, a lot of folks have wanted to put the steepener trade on for really to start this year, but it hasn't quite paid off. We continue to be surprised by inflation. Is now the time finally for that trade?
I mean, certainly I think that the steepener trade is the trade of the year. And given where we are in the cycle, that's what you would expect, that re-steepening in the curve to occur. I think last week we did have that bounce in initial jobless claims really kind of spook the markets, anticipate this Fed pause. So timing that move could be a little bit tricky. Where we are seeing opportunities in the US curve is really around the belly of the curve. So the front end we think is going to have more volatility as we really wait to see how the data unfolds for the Fed's policy path to get more clarity there. The long end, the fact that inflation, I mean, core PCE is about that 4.7% mark on average of the past several months, investors will likely demand higher term premium to park out in those long-term tenors.
Right.
So it's really the belly, the 3 to 7 year, where we have seen yields back up to the highs that we have seen in March. So valuations are more appealing. And when we look at for previous Fed pauses, we do tend to see that segment of the curve really be the one that outperforms. So that's where we are seeing more of comfort in taking that duration exposure.
Laura, I'm afraid we're going to have to end it there. Thank you so much for joining this morning. Really appreciate it. That is Laura Cooper, BlackRock Senior Macro Investment Strategist. Coming up, Permira is hunting for investments with low double-digit yields after raising $4.5 billion for its latest and fifth fund. We're going to be speaking exclusively with David Hirschman, head of private credit at Permira, next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Now, the world of private credit has been rapidly expanding, eating away at the market share of banks and growing to $1.5 trillion. One of Europe's largest direct lenders, Premier Credit, has just closed its latest funding round, raising $4.5 billion for its fifth fund. Joining us now exclusively is David Hirschman, who heads up private credit at Premier. David, thank you so much for joining this morning.
Thanks for having me, Danny.
Look, it's we were talking in the commercial break, and I was basically saying to you, like, I'm tired of hearing that it's the golden age of private credit, but it kind of is, right? There is so much demand right now. Where's most of that demand coming from? Are you seeing different types of investors now interested in your products?
We do. So obviously, we're very pleased with the result and the fundraising for our fifth vintage. And we're seeing institutions from across the world, mainly pension funds, insurance companies, some of our existing investors from previous vintages, but also new investors. That shows a very strong appetite for the asset class. And also coming back to your point about, is this the golden age of private debt? I mean, in many ways, we think it is, because we're getting very attractive risk-adjusted returns, probably better than what we've seen in the last 2 decades. But we also have to be mindful that it's a volatile environment. We have to remain very disciplined. And so I think you can't raise 4 or 5 billion euro of capital without a very solid track record. And that's what investors want to see.
What happens if you don't have that track record in this environment? Because a lot of people want to ride that same trend you're talking about. Are they able to?
Well, I think we're going to see differentiated performance across key asset managers in private debt in Europe over the next few years. There is going to be clearly a difference in the consistency of track record, the default rates, the loss rates, and I think that's going to separate the good from the less good players in the market. And ultimately, there may be consolidation, but some asset managers will maybe leave the market and not be able to raise another fund.
What would consolidation look like? Is it possible to do mergers among private credit? I don't know if the structure is set up right, or do you just have firms that go bust?
Well, so what we've seen more so in the US, I think, than in Europe, but there has been consolidation. Now, in Europe, it's still relatively early stage. There's not been really a lot of consolidation in the market. But we are also in a very consolidated market already. If you take the top 10 players in Europe for private debt together, which we're one of them, we account for about 80 to 90% of all the transactions in Europe. But the key, I think, is really the quality of the performance and the quality of the portfolio monitoring, having a very solid portfolio monitoring team involved early on in the investment decision process. And I think that's key to minimize losses, minimize defaults over the life of a fund.
And one of the reasons popularity has grown is this step back from banks, especially this environment this year. Do you expect banks to come back at any point and kind of re-grab some of the market share?
Yeah, I think at some point they will. I mean, clearly, private debt has gained a lot of market share in the last 12 to 24 months. Which is what we had seen in the US. In fact, we think Europe is probably 5 to 10 years behind the US in that respect. Banks will come back, the syndicated loan market will come back, but sponsors have seen the advantages of working with private debt funds, even for large cap transactions. So it's not unusual to see a club deal, a €1 billion debt or more with 5, 6, 7 lenders. What makes the private debt product attractive for those sponsors is the certainty of execution and the availability of a delayed draw piece, which makes it really compelling for sponsors. And I think that even when the syndicated loan market reopens, private debt remains a very strong and competitive source of financing.
One of the other differences we've seen from public credit markets and private ones is in the public market, there's a lot of data out there of defaults starting to pick up. There's a stat from Goldman that so far defaults this year exceed, in the US market specifically, already exceed 2021 and 2022 combined. But we really don't hear much of a peep out of private debt markets. Why is that?
Well, maybe not yet, but it's true in a volatile market, you expect to see an increase in defaults. What we see in our market is private debt in particular in the last few years has concentrated on non-cyclical industries with businesses with high margins, high cash flow generation, and relatively low loan-to-value ratio, which means there's a lot of equity in the capital structure at the outset. That in itself, high cash generation and comfortable debt service coverage ratio mitigates the risk of a default. Now, obviously, if we enter into a recession, that was clearly the fear, deep global recession a year ago, we might see an increase in defaults. But so far, I mean, a lot of this is private information, so I only have really visibility on our portfolio. But we're not really seeing an increase in default rates.
Okay, David, I'm afraid that's all we have time for. Thank you so much for joining.
Thanks very much for having me.
Congratulations again on the new fundraise. That is David Hirschman, Head of Private Credit at Premier Credit. All right, coming up on the show, what's the way forward for European banks? We're going to get the view of Goldman Sachs International CEO Richard Nodde in our exclusive interview next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there, the kind of upside.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Goldman Sachs International CEO Richard Nade says the bank is seeing some green shoots that signal a pickup in IPOs. Speaking exclusively to Francine Lacqua, Nade also discussed potential job cuts, market volatility, and the European banking sector.
Well, to start with, they're in a much stronger place than they've been for, well, probably 15 years. And so if you look at strength of balance sheet, capital ratios, probably 3 times what they were going back to 2007. Liquidity, much, much stronger. And really the underlying strength of the balance sheet is strong. So whatever lies in front of us, I think we're in a good starting position.
Are you confident that what will be in the pipeline, so it could be M&A and IPOs, will get better rather than get worse from here?
I think we're starting to see some green shoots, in terms of IPOs. We've got a number of IPOs in the market right now. They've still got a price. Some of the IPOs done in the earlier part of the year got done but didn't trade so well afterwards, and that's obviously a key measure. So one is the pricing and then the aftermarket performance, so we'll have to watch that. There's been a lot of block activity. There's been a lot of secondary sell downs throughout this year, and the market has absorbed those and absorbed them well. On the M&A side, corporates are certainly looking. We saw another big healthcare transaction announced this morning. The sponsor network is looking. Some things are getting done. I think the bid offer is still too wide. So from a pricing point of view, we haven't quite gotten there yet. But you can see people are looking to do things. So there's signs of activity, yes.
Do you worry that actually you're losing business, that Wall Street titans in general losing business to either smaller boutiques or brokers or even domestic banks?
No, I think we have a lot of confidence in the strength of our M&A franchise. And it's really built on, well, first, a hugely experienced team across geographies, across industrial sectors. People who've been in the business for a very, very long period of time. And it is an experience-based business. And being able to connect the dots on a global basis, and I think that's become, if anything, more and more important. So there's that component to it. And then the financing component, and being able to bring the full package. And, it's one thing knowing what you want to do, it's another thing being able to finance what you want to do, and we can help on all fronts. And so I think we feel good about our franchise, but it comes down to client relationships, being part of that intimate dialogue, and certainly from where I sit, I see that as strong as ever.
Are you done with job cuts?
Well, we right now, as we disclosed last week, going through a process for a small number of people, 250, thereabouts. We obviously had a more significant exercise at the beginning of the year. And that's all in response to our perception that markets were going to slow down. They certainly have slowed down, and some ongoing weakness across markets. And so we want to make sure that the firm is right-sized. The reason that this exercise is very targeted and small is that we're really targeting those parts of the business which are slowing down. Not all parts of the business are slowing down.
Goldman Sachs International CEO there, Richard Naudet, speaking exclusively to us. Now let's get to the Bloomberg First Word News. With that is Sarah Halls. Sarah.
Thanks, Danny. China's central bank has cut a short-term policy interest rate, easing its monetary stance to help aid economic recovery. The PBOC lowered the 7-day reverse repurchase rate by 10 basis points to 1.9%. The easing comes ahead of the PBOC's monthly operation on Thursday of its medium-term lending facility. 7 of 16 economists surveyed by Bloomberg also expect a reduction in the one-year MLF rate. JP Morgan has agreed to pay $290 million to settle a lawsuit alleging it knowingly benefited from sex trafficking by former client Jeffrey Epstein. The bank says the agreement in principle would settle a class action filed last year by an unnamed Epstein victim. A source says the bank will not admit liability. In a statement, JP Morgan says its association with Epstein was a mistake it now regrets. U.S. Secretary of State Antony Blinken says the Trump administration was slow to counter Chinese spying overseas after discovering that Beijing had been operating a spy facility in Cuba since 2019. He says the past administration was aware Beijing was expanding its intelligence efforts and failed to slow it down. The White House has acknowledged the presence of Chinese facilities in Cuba that could be capable of spying on southeastern parts of the U.S. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Danny.
Sarah, thank you very much. Coming up on the program, Ukraine's Europe allies meet in Paris as Kyiv pushes ahead with its counteroffensive against Russia. We'll have the details of that meeting and what's to come for NATO next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch That's Francine Lacqua, Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
The unstoppable NASDAQ tech shares fuel global equity gains ahead of today's all-important U.S. inflation print, the final piece of the economic jigsaw before tomorrow's Fed decision. Stimulus required. China is said to be weighing a broad range of measures that include property support to spur growth after an unexpected cut by the PBOC to short-term interest rates. Plus, the UK two-year yield rises to its highest since 2008 as the labour market unexpectedly tightens. Shortly, an exclusive conversation with UK Labour leader Keir Starmer at London Tech Week. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Emmanuel Macron says he hopes Ukraine's military counteroffensive against Russia will be as successful as possible and lead to talks. The French president met with the leaders of Germany and Poland in Paris yesterday to discuss coordinating military assistance to Kyiv. For more on this, let's go out to Europe correspondent Maria Tadeo in Brussels. So, Maria, we had Macron, Duda, and Scholz all reiterating their support for Ukraine. But what about the long-term plan for long-term security?
Yes, Danny, good morning. And this is the Weimar Triangle. These are countries that are strategically important for Ukraine, politically, of course, but also geographically, especially when you look at a country like Poland. And yes, they repeated yesterday, we will stand with Ukraine for as long as it takes. I was personally particularly struck with the words coming from the German chancellor, who said Vladimir Putin made, quote, a fatal mistake when he invaded Ukraine. And you alluded to this, and this is particularly important, the words of Emmanuel Macron, too, who said he had a conversation with the Ukrainian President Volodymyr Zelensky and appeared to also confirm that this counteroffensive, remember there had been a lot of secrecy around it, is now indeed underway. The French president also signaled that it could go on for weeks, maybe even months. But again, going back to this idea that if Ukraine wins the upper hand on that counteroffensive, it will be better placed to therefore then talk about peace. But beyond that, Danny, there is a fundamental question here, and this is why this meeting yesterday is so relevant and is so important, and is this idea of what kind of security framework can the West provide to Ukraine? And when you speak to diplomats behind the scenes, they tell you by now it is clear there is a pattern of aggression from Russia to Ukraine. They have not been able to contain it, and they have not been able to break this pattern. So obviously the country needs a new framework. The issue, and this is really the issue, when you talk about security framework for Ukraine, it can mean anything. Some talk about the Israeli model. Other people talk about bilateral security assurances for Ukraine. And then, of course, there's always that perennial debate about should Ukraine enter NATO. But the significance of the meeting yesterday is that it finally triggers and kicks off this debate among European countries. Obviously, the United States will be a key player, and that takes us to the Vilnius summit in Lithuania that will happen next month. That is seen as a crucial moment again for NATO, but also this idea of what is Ukraine's relationship when it comes to the biggest military alliance.
Well, elsewhere at that summit, Maria, at NATO summit next month, what you're talking about, are we likely to see Turkey finally give the green light to Sweden's entry?
Look, and this is becoming now, at this point, incredibly problematic for the Swedish government. They were waiting for the Turkish election. Now we know Erdogan won that election. To some extent, they're already familiar with him and already negotiated this entry a year ago. But the Turks still say Sweden has to do more when it comes to some of the issues on issues like terror, that they believe the Swedish government could be doing more. The problem, of course, is that the Swedes say they have done enough already, and it's now Turkey that needs to move. There is a meeting planned for this week, but sources tell Bloomberg that not a lot will happen. Do not expect a breakthrough in that situation, but the clock is ticking. The Secretary General of NATO also repeating Sweden has to join at this point. It's the only way to guarantee the Nordic security, but also you've created this situation where Finland has joined, but its closest ally and neighbor, Sweden, has not. So that is obviously becoming not just a military problem in terms of NATO, but also politically an issue for Sweden.
Okay, Maria, thank you very much. That is Maria Tadeo, our Europe correspondent in Brussels. Now, quick check on your market. U.S. futures are moving higher. They are led by tech. I was just quickly looking up the Oracle pre-market trade. They had earnings yesterday. Post-market, they surged. Pre-market up another 4.5%. If that sticks, it will be an all-time high. It really is this euphoria in tech. No fear for today's CPI. Apple also hit an all-time high yesterday. Tesla, its 12th day of gains. That is a record streak for the EV maker. Also looking at their pre-market, they're up yet again, 1.3%. Elsewhere, the macro stories revolve around China. Reports of more support there and the UK, an unexpectedly tighter labor market, a surge in wages and unemployment dropping. That has caused what you're seeing there, the 2-year yield up another 13 basis points. That is leading the gains. The belly, the 10-year yield, that's moving about 5. 5-year yield, that's moving about 11 basis points. And what we have is a UK 2-year yield, which has surpassed the Truss era high. It is now trading at a 2008 high. Of course, the difference this time is the run-up. Yes, it has been steep, but not as steep as the Truss era. And that was really led by the long end of the curve because of what we saw in the LDI crisis, having to sell off some of those assets. So it's not the same type of market panic, but this is significant nonetheless. It is pricing in about 5.6% or higher for the terminal rate for the December rate. We're just talking to Laura Cooper over at BlackRock, who is saying that they don't expect that. They expect something like 5%. So there is indeed some repricing that needs to be done on this market. Okay, coming up, we're going to continue this conversation because there is a lot to discuss with the UK labor market unexpectedly tightening. We have that response in gilt markets. We'll dig into all the numbers with Lizzie Burden next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From the wizards and capitals to new ventures and innovative investment, running a sports empire in Washington, D.C. is a monumental task. Owner Ted Leonsis trusts CFO Peter Bichet to execute monumental sports and entertainment's financial game plan.
We are definitely in growth mode. What else can we do? How do we grow the platform?
Watch Chief Future Officer, Wednesday on Bloomberg. Top top names in business are on Bloomberg.
The energy in Shanghai was like New York on crack.
Things are going to get worse in the economy at the same time as you have this internal conflict.
We need more bipartisan conversations because this is an American issue.
Are some of these assets commodities or are they securities? And we've been asking the SEC for a long time.
But I think there's more problems under the surface.
It's incredibly exciting, as important as the birth of the internet.
Nobody covers business like Bloomberg, your global business authority.
Let's talk tech. Google DeepMind is one of the UK's leading artificial intelligence research labs. Its CEO and co-founder says that AI will massively accelerate scientific and medical breakthroughs in the next few years, with the potential to treat illnesses like cancer or dementia. However, Demis Hassabis warns that there are potential downsides. He spoke exclusively to Tom McKenzie at London Tech Week.
I think there are three different types of, broadly speaking, buckets of risk. I think number one is bad actors using these dual-purpose technologies in ways that are bad for society. I think that's true of any new transformative technology down the years, so I think AI is no different, other than the fact that it's maybe the most general type of technology. So that becomes a question of access to these technologies, and that's what needs to be thought about there. I think the second one is near-term use cases where things like deepfakes or disinformation or bias in our systems that can affect near-term products and applications that we see today. And I think that has to be mitigated by some new technologies, things like watermarking, and so you can detect deep fakes, but also existing regulation being beefed up in areas like health or transport to deal with the coming new wave of AI, just like we did with the internet and mobile. And then finally, there are these longer-term technical AI risks that I think more research is required to understand them better, understand these systems, where they're going, to allow us to sort of figure out what the bounds are of what these systems can do, how we can control them, how do we align them to human preferences. And then once we understand those better, we can sort of, government and others, international society can sort of put the guardrails around it. So I think it's important when you're in regions of, accelerating technology, high uncertainty. Doesn't mean things are going to go wrong, but it means that we're as uncertain about what the underlying technology is going to look like in 5-10 years. Then I think we should proceed with what's called the precautionary principle. So proceed with exceptional care and thought, and use things like the scientific method.
You're very used to putting probabilities on things. So I just want to push you on the most extreme area and the most extreme risk. And I feel it feels hyperbolic to talk about hyperbole, to talk about potential extinction as a result of AI. But in your time, whether it's developing games or as a chess grandmaster, you know about how to put probabilities on things. What would you put the probability at of AI-linked extinction?
Well, look, I think it's I don't think no one can put a probability on these things. I think there's a huge amount of uncertainty. The probability, many of my colleagues think, is very small. But even if it's very small, one should pay attention to those things and ahead of time, not wait for those things to happen. And if you look at things even like, much less powerful things like social media of the last decade, fantastic benefits to society, many things in individuals in our social lives and so on, but also has unintended consequences, as we're now seeing. And so I would like us with AI to get ahead of those things and to be pre-prepared and to put down the guardrails, society put down the guardrails ahead of time, not after the fact. And I think it's too important in technology not to get that right. So I think all that letter was saying is we should pay attention. And, I think the Prime Minister and other governments are. And I think things like the Global Summit that the Prime Minister announced in the UK, bringing together experts from around the world, from academia, from civil society, from government and from industry, to come and talk about these risks and these opportunities, and then what can be done to mitigate them. For example, come up with the right evaluation tests and benchmarks to evaluate what these systems can do and the capabilities they have, I think is the right next step. So,
for those who would say, look, even if there's just a 1 or 2% chance of a catastrophe, then just stop where you're at. What would you say to those people?
Well, as I said, we have no, at the moment there's a huge amount of uncertainty over these future technologies. Very hard to predict what's going to happen in 10, 15, 20 years' time. If you think back to 10 years ago or 15 years ago when we started DeepMind, no one thought AI was possible. No one was working on AI. When I remember when I was doing my postdoc postdoc in academia, the professors would eye roll at your even the mention of AI as being something that's science fiction and not a serious subject. And look how far we've come in the last 10, 15 years. So I think it's hard to predict things going forward. But the reason to work on AI is what we discussed at the beginning, which is the potential it has to help society with all of these challenges that we have, from disease to climate to energy. All of these things, I think, can be impacted and helped by a technology, an incredible tool like AI, helping the world's experts solve these problems.
And what would you advise governments, not just the UK government, governments around the world, to focus on, to prioritise now in terms of policies they can enact now to put some guardrails in place around this technology?
I think the number one thing that needs to be done right now is to put more investment into AI safety research and understanding what these systems can do, analyzing them, interpreting them, and then coming up with things like evaluation benchmarks so that we can understand what capabilities we want and what guardrails that we therefore should have to make sure society reaps all the benefits of these systems and the incredible potential they have, and we mitigate the risks.
Last question on jobs. You have children. Would you advise, what jobs would you advise your children to steer away from because you think that in 10, 15, 20 years they're just not going to exist?
Again, I think the whole jobs question is a very complicated one to predict. As with, there's no doubt that AI is going to bring changes and disruption. But I actually think if you look at the history of these things like internet and mobile over the last 10, 20 years, they also cause huge changes. But actually, whole new categories of jobs were invented. Actually, better quality jobs, higher paid jobs, and I think that's what's going to happen again with AI. I think it's going to change the job market. But I think in the fruition, fullness of time, I think it's going to create many more higher quality and better paid opportunities than we've had in the past.
Demis Hassabis there, the CEO and co-founder of Google DeepMind, a fascinating conversation and maybe a scary one with Tom McKenzie at London Tech Week. Now, also at London Tech Week, Bloomberg spoke to Mayor of London, Sadiq Khan, about the opportunities in AI for the country.
It's really important that we try and understand the importance of not just AI, but other innovation coming in the tech sector. Not be scared of innovation. Innovation is good. What innovators want is some certainty. They want to know what the rules of the game are. They often want, regulation, small r, and sometimes big R as well.
Tell you, it's not just Sadiq Khan, it is not just Google DeepMind. Everyone is excited, especially in this market, about AI. If you mention it in your earnings call, you probably have a good chance of seeing your shares push higher. We saw with Oracle yesterday a record price now on Oracle. If it's able to hold onto these pre-market gains, 4 1/3% is where we move. Their cloud demand, it was strong, specifically citing what AI has done to their cloud demand. So now we're looking at Larry Ellison, who's for the first time richer than Bill Gates. Congrats, Larry. Now, elsewhere in tech, Bloomberg is compiling a list of the UK's most promising startups. If you know about a company that's doing something really innovative and unique and deserves some attention, let us know, won't you? That story is to come. But first, coming up here on the program, an exclusive conversation with UK Labour leader Keir Starmer at London Tech Week. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Some breaking news to bring you on Crispin Odey's former fund, Odey Asset Management. According to a letter to clients seen by Bloomberg, they will be gatekeeping one of their funds, the Brooks Develop Market Fund, so no redemptions to come from there. We'll keep an eye on that. All right, let's pivot now and talk about London Tech Week. Let's take you over there because Bloomberg's Francine Lacqua is in a conversation with UK opposition leader Keir Starmer.
Acknowledge it. As I say, send our thoughts to those that are affected and thank those that are responding to it on behalf of all of us.
Yeah, and Sir Keir, before we get on to tech, actually, on AI, it's been quite a weekend for UK politics.
It has been quite a weekend for everybody following. So on Friday night, I was doing a speech for Margaret Beckett, who's one of our longest-standing MPs. She's been an MP for 49 years. And I was in Derby with about 550 people thanking her for her service. And as I sat down, I got a note put in front of me that said, Boris Johnson has resigned with immediate effect. And then on Sunday, I went for lunch. It was my wife's birthday. Went for lunch with a number of friends. And just as we were sitting down, I saw my phone ping up that Nicola Sturgeon had been arrested. So it's quite a lot to pack in to one weekend. And obviously, it comes on the back of a very turbulent 12 months or so. This time last year, Boris Johnson was Prime Minister. We've burnt through 3 Prime Ministers. We've had 4 Chancellors and 4 budgets in the last 12 months. And, you know, politically, that makes for a lot of material. It is certainly evidence of chaos. And political parties usually fight like this when they're out of office. It's very unusual to have it when they're in office. And now we've got 3 by-elections caused by just political fallout. Often you have by-elections because someone sadly dies or is very ill or there's some finding against them. To have 3 by-elections which are essentially political tantrums is really unprecedented. And, you know, politically, obviously, from our point of view, you know, we look at it and see that chaos, but there is a price to be paid. And everywhere you go across the country, most people are really worried about the cost of living. They're worried about how they're going to pay their bills. And for them to see a government squabbling with itself instead of focusing on what they need addressed, I think is, you know, a very serious situation for this government to have got itself into. And there's a deeper price because there's a reputational hit to the UK. And I think there's an economic hit as well because many investors, and this is very relevant to what we're discussing this morning, many investors say to me, we're not investing in the UK right now because we don't see the conditions of certainty and stability that we need in order to invest. And that will affect people in this room, it'll affect startups, businesses, not only in tech, but across many, many sectors. So there's a political price of this chaos as well.
But with the implosion of the SNP, do you see, what kind of opportunity do you see for Labour in Scotland?
Well, the implosion of the SNP has been very profound. And I think it's done 2 things. It's now allowed a proper examination of the SNP record in government. Until this point, the SNP was quite able to ensure that the only discussion in Scotland was about independence, about the referendum, constitutional issues, and not about the things that actually, in many respects, matter so much more to people. So now that torch, if you like, that light is shone on their record, and it's not a very good record. From our point of view, it obviously gives us an opportunity to make an argument about Scotland, about the future of Scotland, that, you know, means we are more likely to be heard as we go forward. We've got a strong case to put in Scotland, a very positive case to put in Scotland. It doesn't necessarily flow that because the SNP implodes, SNP voters necessarily move to a different political party. We've got to earn every vote, we've got to make our case, but we've now got the chance to make that case.
So we're at London Tech Week.
Yeah.
When you look at AI, is it a risk or a benefit?
I mean, a bit of both. There is huge potential, and everybody in this room knows that, and you know, incredible opportunities. I did a speech on the future of the NHS a few weeks ago, and my main thesis was the NHS is face down on the floor. It needs to be back up on its feet, but more than that, it needs to be fit for the future, which is a different question. Part of making it fit for the future is using technology to a much greater extent. There's an important report come out this morning on that. And one of the examples I used in my speech, which is about AI, was if a radiologist works with AI when doing scans for cancer, particularly liver scans, they're 60% more likely to get them at an earlier stage, which makes a massive difference, obviously, to the individual patient, and a huge difference to the NHS as well. So huge, huge potential. But of course, risks of misinformation, risks that it's used in ways which we wouldn't consider to be good. Risks more broadly that AI is accelerating so very fast that some of the jobs that are being done now by people will almost certainly be being done by AI, already are to some extent, but I'm really struck by the speed of acceleration of development in AI. And so we need to put ourselves in a position to take advantage of the great benefits, but guard against the risks.
Do you use ChatGPT? And if so, what do you ask it?
But so, I have a masterclass on ChatGPT almost every day because I've got a 14-year-old son.
I'm afraid I'm going to have to jump in here with an excellent question, but this is a good tease. Go watch the rest of this conversation on Live Go. I want to know what Keir Starmer asked ChatGPT. That's, of course, the UK Labour Party leader there with Bloomberg's Francine Lacqua at London Tech Week. Previously, she asked him about the upheaval for SNP, him saying that it means Labour will be heard in Scotland, but they still need to earn every vote. Again, go watch that. Live Go on your terminal.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today...
So yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Nugent Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The latest U.S. inflation numbers come out today. They may give support to Fed officials looking to put their interest rate hike campaign on hold. More signs that China is growing worried about a slowing economy. Beijing is now considering a broad package of stimulus measures, and the central bank surprisingly cuts a short-term interest rate. And Donald Trump's day in court. Thousands of supporters are likely to show up in Miami when the former president faces criminal charges of mishandling classified documents. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And markets here in Europe certainly moving on the China story. Certainly some optimism around tech still hanging around the global equity space. But really, we'll be focused on the CPI print come this afternoon, Europe time, Kriti.
Yeah, the inflationary story is fascinating, of course, stateside in Europe as well. But it's interesting how much of the inflation story is really coming from the Asia-Pacific region at a time when they're really trying to spur a little bit of that growth. We're going to dive into that, but it is a major market theme because it has ripple effects around the world. Futures higher by about 0.3% on that exact sentiment that you were just mentioning, Anna. What's important to me, though, is a read-through into the bond market. We're going to get to that in just a moment, but the two-year yield here, 4.56, as, of course, we see yields drop by just 1 basis point. A lot of that caution seems to be coming off of just what we're going to see from the CPI report today and, of course, the Federal Reserve tomorrow. But let's go back to the China story, Anna, because, again, that is going to have a massive effect on what happens here stateside. Remember, after the global financial crisis, part of the recovery was massive infrastructure stimulus from China in 2009 and, of course, 2010 as well. So as you start to see the 10-year yield move, what's important to keep in mind here is that it is a 6 basis point move. That is a more than 4 standard deviation move for the Chinese debt market. Enormous when you look at the read-through. And, of course, copper as well, taking in on that risk kind of climb higher by 1.6% as we look at that commodity, Anna.
Let's have a look at the European markets then and the read across from that China story, the cut in the 7-day repo rate and the talk of broad support for parts of the Chinese economy, including perhaps property. This is what we see then across European equity markets. Some positivity coming through. This after strength in tech yesterday, also being echoed here in Europe. So we are up by a fraction of a percent on the London market, the same over in Germany and in France. So modest gains coming through across European equity markets. I should mention what we're seeing on the investor sentiment side. We've just had a survey, the survey results from Germany, their June ZEW Investor Expectations Index. That's risen to minus 8.5. The estimate was that this would have a double-digit handle, 13 or so. So certainly this number coming in better than had been expected in terms of investor sentiment. So that's what we see across European equity markets right now. The euro fairly unmoved by that latest ZEW survey. It was benefiting. It was moving higher as we'd seen the dollar in retreat today before we got this data. But that minus 8.5 compared to the expected expected, minus 13.5, that was the number. That hasn't moved the euro too much, but maybe consolidating a little positivity there. Let's get back to the top of the board. This is where you see the read across from China, up by 2.3% on basic resource stocks. That plays well for London, of course, benefiting that particular sector breakdown in the markets. The UK two-year yield is really fascinating to say today. We're up by 12 basis points at the two-year horizon. The labour market looking really tight. We'll get some further details on that, both in terms of the unemployment rate, which unexpectedly showed more tightening on the labour market side, so a tighter labour market than had been expected. We also got wage data that came in higher than expected, so all of that adding up to more rate hikes from the Bank of England, and the market adjusts its expectations accordingly. The same is said for the pound, so the pound jumps on the back of that data. It was positive before that data, and you see compared to the euro, we're not seeing such an outsized move on the pound, but we have seen the markets repricing expectations around the terminal rate for the UK. Chrissy?
Certainly a lot of green on the screen, Anna. A lot of it coming off of the story you're seeing in the Asia-Pacific region, which is where we go to next. China mulling a fresh package of stimulus measures to boost its economy, according to a Bloomberg report. This comes as the PBOC surprised markets with a rate cut earlier today. Bloomberg economics reporter Jamie Rush joins us now for more. Jamie, walk us through those potential stimulus and the potential read-through around the world.
Well, China's economy is slowing. Its growth rate is slowing. We've seen that we've got weak PMI data illustrating the scale of that slowdown. And so the government is going to need to do something. And the question is what? So we've seen immediately already a 10 basis point cut in the repo rate. That's likely to be followed by a 10 basis point cut in the marginal lending rate later on this week. And so monetary policy is now responding. And we think there's probably more to be done. I mean, if you think about China's economy, there's a massive infrastructure overhang, certainly in the residential sector. That's not necessarily the right lever to be pulling right now. We think there is much more for the central bank to be doing. Today's measures probably only add about 0.1 to the growth rate. At least that's what our economic models tell us. So there is more to be done. We think maybe another 20 basis point cut is coming over the rest of the year.
Okay, so today's focus has been on that 7-day repo rate, but there is building expectation. I know you have expectation that we get a cut to the medium-term lending facility as well. So we'll look for that later on in the week. Let's pivot to the UK economy, because we had jobs data out a few hours ago then, Jamie, and we'd expected that we'd see a little bit of loosening of the labour market story in the UK. Well, we didn't get that. We got more tightening, didn't we?
Yeah, so the last report showed that the employment had dropped massively. That's been revised away completely. So any evidence that the economy was cooling has now just disappeared. And we've also seen very, very strong numbers on the prices side, on the wages side. And 7% pay growth, you don't need to be a genius to realise that's not going to be compatible with 2% inflation rate. So there is a lot more for the Bank of England to be done. We're seeing markets repricing. We've changed our forecast. We think rates will go a bit higher. But we'll see what the gravitational pull of the Fed does over the summer as that hiking cycle potentially comes to an end.
Okay, interesting one to watch, the domestic dynamic versus that international dynamic across the Atlantic. Jamie, thank you very much. Jamie Rush joining us there from Bloomberg Economics. Now, SoftBank-backed chip designer ARM is said to be in talks with potential investors, including Intel, to anchor what will be one of the largest IPOs of the year. Bloomberg's Alex Webb joins us now with details. Alex, how big could this IPO be then when we get to it?
So the reporting suggests they're looking for something in the order of $10 billion. They're looking to raise, still a question mark. Bankers have pitched anything between $30 billion, which is actually about the price that SoftBank paid for it a good few years ago, and $70 billion. Given the IPO market, well, we'll have to see the way things are. It's a terribly bullish place to be right now. The fascinating thing
Okay, looks as if we're having a bit of problem with Alex's line, which is a shame because he's here in the studio somewhere, not that far away, but we seem to be having a little problem with the technology there. A really fascinating story, though, the involvement of Intel in that ARM IPO then, Chrissy, because what is in this for Intel is really fascinating. If they want to turn themselves into more of a foundry, making chips on demand because, clients to other people's designs, effectively, then they're going to need to get closer relationships with chip designers, and that if you want that, then you need to have a relationship with ARM. So that seems to be what this is all about.
Of course, and for a global audience, it's important to remember that ARM is the kind of unique designer when it comes to graphic chips, and essentially the design on new innovation when it comes to things like really sizing up the production there. Also, the fact that Intel is actually using this IPO as potentially part of its turnaround plan, Anna, is enormous, because they are just now recovering from kind of the major restructuring that Pat Gelsinger had to lead over at that company. And it's not the only company, by the way, that's moving and that's having these big grand plans, because Oracle is in the same boat. Oracle we like to look at as kind of this old tech name, Anna. Their shares jumping to a record high because they use the magic word artificial intelligence, but also because the cloud unit there drove that sales beat higher by 4.3%, Anna. And get this, Larry Ellison, now one of the, I want to say one of the richest men in the world, surpassing some of the folks on the Bloomberg Billionaires Index.
Absolutely. All you have to do is mention of AI, and you go from lower down the rankings up into number 4. He's pushed Bill Gates out of the number 4 position to take that, with Oracle shares up by 42% year to date. We need to talk about US politics, Chrissy.
We absolutely do, because we go from the tech story to the political one. In Miami, police say as many as 50,000 people could turn up when former President Trump appears in federal court today. He's expected to plead not guilty to charges involving the mishandling of classified documents. Trump loyalists have promised a show of force. Bloomberg's Kaylee Lyons is on the scene in Miami, waking up early for us this morning. Kaylee, what does President Trump's schedule look like today?
Well, he already has been here in Miami since yesterday when he flew down from New Jersey, Creedy, and it's really just a waiting game until 3 p.m. Eastern time. That is when he's expected to show up at this federal courthouse here in Miami. He will be arrested by authorities in process, potentially have his fingerprint and mugshot taken, and then he will go up to the 13th floor, appear before a judge, and as you said, we expect him to plead not guilty. Of course, since this indictment came down, the former president has claimed his innocence. He has called this a witch hunt, election interference, at the highest level, and that is probably a message that he will take out of the courtroom when he gets back on the plane, heads back to Bedminster, New Jersey, to appear tonight at his golf club there, where at 8:15 p.m. Eastern time he will be speaking and meeting with donors. His campaign believes he could raise $2 million at this event tonight, and that's really what we're waiting to see, is if this particular indictment and court appearance proves to have the galvanizing effect among his supporters and donors, as we saw with the prior indictment that happened in Manhattan earlier this spring. Of course, that was the first time the former president faced criminal charges, but this case here that is being dealt with in Miami today, this arraignment, is the first time he's faced federal charges, 37 counts of 7 different crimes.
Kaylee, great to see you. What kind of protests are we now expecting then?
Well, as you said, we could see up to 50,000 people in Miami today. That is what the police are expecting. And as a result, really strict security is expected throughout the city today. And of course, we have to keep in mind that there has been a lot of rhetoric leading up to today's events. President Trump himself was speaking on radio over the weekend with Roger Stone, one of his former advisors, saying that people need to show up and come and protest peacefully. But it's really a question of whether these protests will be peaceful, because there has been as well a decent amount of violent rhetoric. For example, Carrie Lake, a relatively prominent Arizona Republican, was out over the weekend saying that if anyone wants to get to President Trump, they need to get through her and 75 million Americans like her, all of which she alluded to, or many of which are members of the NRA. So definitely a lot of security will be here today, bracing for any potential disruptions or violence surrounding the president's appearance.
And Kaylee, of course, we know when he went through this iteration right here in Manhattan, a lot of the concern was around what that would mean for 2024, and yet it didn't really mean a whole lot at the time. Has any of that changed in terms of support for him as a candidate?
No, this appears to be a pattern. We actually saw President Trump's polling go up in the light of his first indictment. And after this second one, it appears that he really still has not lost the support of his base. A CBS YouGov poll came out over the weekend that showed 76% of likely Republican primary voters thought that their concern was that this is politically motivated, not that national security was at risk. 61% of them said that this doesn't change their opinion of Trump at all. And actually 14% said that it made their their opinion of him better. 80% of them said that he should still be able to be president even if convicted. So it doesn't appear at this point that it is detracting at all from President Trump's front-runner status in this race. And of course, we have to keep in mind, while the legal proceedings really begin today with this arraignment, this could drag out for a long period of time, including up to or even beyond that election in November 2024.
Kaylee, thanks very much. Kaylee Lyons joining us there from Miami with a briefing on the politics and former President Trump. Now, coming up, we look at how today's CPI numbers could impact tomorrow's Fed decision. Is it all going to be about that super core print? We will get to analysis of that, of course, and we'll dig deeper into that data and the broader market themes with Peter Chatwell, head of global macro strategies trading at Mizuho International. Plus, a Bloomberg exclusive, the CEO of Barclays shares his economic outlook and views on the banking landscape.
Credit Suisse and UBS's merger has two important consequences. One, for the financial system as a whole, it has stabilized it because a slightly wobbly G-SIFI bank is no longer there. It's absorbed into UBS in a very solid transaction. The second is, as UBS develops its business model, it will be for Barclays both an important client for our markets business and a competitor for us in investment banking.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Wednesday, will the Fed pause or hike?
The steepest tightening cycle since the 1980s may be about over.
It's a we've never been here moment. And where will they go from there?
They may leave the door open to additional rate hikes.
They say pause and this market hears cuts.
Trust Bloomberg for the fastest coverage and exclusive analysis.
What could potentially torpedo this?
You're not really seeing the slowing in the labor market.
Bloomberg surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, the conversation for the past 2 years or so has been all about inflation. It kind of feels like we're perhaps pricing in the end of that conversation as the Federal Reserve potentially pauses tomorrow. At least that's what the market has pricing. What's interesting, though, is the logic behind it. For our radio audience, stick with me. We're looking at a chart here of near-term inflation expectations, 1 year ahead and then 3 years ahead. And essentially what you need to know is that the line goes up, up, up in 2021 and then really makes a 2-year low as of today. It really speaks to the idea here that perhaps we are really ending this inflationary regime, except when you talk to some of the folks on the market, they say, well, hold on a second. Are we in for this kind of newfangled era of sustainably high inflation? And in that environment, what do you really do with, say, a data set like today's, the CPI data we're going to get in a few hours? Let's bring a true expert. Bloomberg Markets reporter Justina Lee joins us now. Justina, talk to us about that dynamic here. The market pricing in perhaps this end of the inflationary area, whereas perhaps some of the commentary saying otherwise.
Yeah, I mean, economists really are expecting to see a slowdown in CPI today, both in terms of the headline number as well as the core number. And that should give kind of support for the case of what people are calling like a hawkish skip, which means that the Fed maybe will not raise rates this time, but maybe it still kind of sets the stage for another hike kind of at the next meeting. And that's currently what markets are expecting. You know, very low chance of a hike this month, but a way higher chance of a hike next month. And I think that kind of reflects that contradiction you're talking about here, which is that inflation is headed toward the right direction. It is coming down. But at the end of the day, I mean, that's still pretty far from the 2% target that we usually associate with like central banks.
I was speaking to a guest earlier who was saying it is going to be all about that core and how sticky it is, how slow that is to come down, because a lot of success has been had with headline bringing that down, but it's going to be a focus on core then that might dictate market response here. Let's talk about China then, Justina, and what we've seen there. So we saw a cut in the 7-day repo rate. A lot of people are now expecting that the medium-term lending facility rate gets cut, maybe on Thursday. But now we hear talk about a broad package of stimulus as well. There's a lot of news flow coming out of China.
Yeah, exactly. It's kind of funny. We just talked about the Fed, you know, maybe doing a hawkish skip, but China's going in the entirely different direction. And I think, you know, what the news today is about is that China potentially considering a broad base of measures that supports the real estate sector, that supports domestic demand. And I think it's interesting because earlier we can see some reluctance on the part of policymakers to repeat what they did after the 2008 global financial crisis. But I think there's still a lot of questions in the market about whether this is going to work. Because it seems like this time around, it's not just a matter of supply side issues. It's also a matter of domestic demand, and that can be harder to tackle. But if it does work, I mean, we are expecting support for emerging market currencies, emerging market stocks, as well as commodities, and even European stocks, given the linkages, you know, with the luxury sector and with the resources sector.
Yeah, we certainly see those resource stocks go higher today. Justina, thanks very much. Bloomberg's Justina Lee with the latest on China and other market themes. And for further market analysis, the CPI print later, the Fed, the Chinese data, oil, as you can see there on your screen, go to the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. OD Asset Management has halted redemptions from its Brook Developed Markets Fund. That's after requests exceeded 10% of the fund's net asset value. OD has been braced for redemption requests since ousting founder Crispin Odey over the weekend in the wake of sexual assault allegations. Meanwhile, Goldman Sachs has rethought its prime brokerage relationship with Odey. We spoke with the CEO of Goldman Sachs International.
As a firm, and frankly our people, we hold ourselves to extremely high standards, and we expect the same of our client base, and that's how we work together in partnership. And so, when new information comes to light in any situation, we'd obviously review it quickly, and then take the appropriate action.
So what, you've severed ties, or are you still contemplating what happens next?
We're in the process of moving away from that business.
Crispin Odey has denied the most recent allegations against him. Binance US is trying to prevent the SEC from freezing billions of dollars of assets on the cryptocurrency exchange. The company urged a federal judge to reject the agency's request, saying the move would cripple its business and hurt customers. The SEC sued Binance last week, arguing that it has blatantly disregarded U.S. securities laws. And for the first time since the start of the COVID pandemic, offices in New York City crossed the 50% occupancy market. That's according to data from security firm Castle Systems. It says occupancy last week was up more than 4 percentage points from the week before. Anna, it's fascinating here to say that office occupancy has broken that 50% level at a time when a lot of people are saying, look, New York City is back. It's like they never left. But I gotta say, living here for almost half a decade, it doesn't really feel like those pre-COVID times have really come back. And I wonder if it ever will, not just here in New York City, but around some of the major cities in the world.
Yeah, and I wonder what more recently the wildfires in Canada have done to people's assessments of whether they want to go back into offices or not. Interesting data for sure. We've seen big tech, law firms, Wall Street, a number of businesses calling their staff back to the office, haven't we? Tightening up those regimes in terms of how many days people are able to spend working from home and how much they must be returned to office. But on the other hand, these are still tight labor markets on both sides of the Atlantic. You wonder where the power dynamic really lies on that front.
Yeah, and commuting is a really big part of that. The Biden administration, for example, is supporting a measure that would actually increase fares of people coming into the city. How does that affect just how much people actually want to make that commute?
Yeah, coming up in the program then, we'll get back to the macro, talking of fares and rising prices. Ahead of today's CPI print, we will talk about that and the Fed's imminent decision. Peter Chatwell joins us from Mizuho International. What does he make of the market's expectations for how close to the top we are in terms of Fed rate hikes? This is Bloomberg.
Or get a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The latest U.S. inflation numbers come out today. They may give support to Fed officials looking to put their interest rate hike campaign on hold. More signs that China is growing worried about a slowing economy. Beijing is now considering a broad package of stimulus measures, and the central bank surprisingly cuts a short-term interest rate. And Donald Trump's day in court, thousands of supporters are likely to show up in Miami when the former president faces criminal charges of mishandling classified documents. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot going on in this kind of market narrative, and I have to say the political narrative as well. But I have to say it feels like the inflationary story and the Chinese growth story really taking the cake when it comes to the market trade.
Yeah, absolutely. The China story certainly filtering through here into Europe. We see some of those luxury names benefiting from China signaling that it is going to come forward with some kind of broad stimulus for the Chinese economy. We've seen some monetary policy change on the 7-day repo rate already. Will we get more of that medium-term lending facility in focus come Thursday? So all of that adds up to positivity for stocks, and we see that echoed here in Europe, up by 0.2%. Here's another sector that really benefits from that, up by 2.4% on basic resource stocks. That benefits London, of course, and we know the linkages between European basic resource stocks and the China trade. This is a focus on UK data right now because, of course, we've had the labour market data out for the UK, and we had expected, Kriti, that we would see a little bit of slack coming back into the labour market here in the UK, and that was what the anticipation was ahead of the data today. We didn't get that at all. We saw further tightening of the UK labour market, both in terms of the unemployment rate, and then we got on top of that the wage story, which also gained either with bonuses or ex-bonuses. It was the same picture. So it was all a pretty hot set of numbers, and that adds up to a higher expectation of rates from the Bank of England, a higher terminal rate. The market is pricing that in. We go up by 11 basis points on the 2-year yield today, and the pound up by 0.4%. I should say it is in good company. The euro also stronger on broad dollar weakness then, Chrissy.
Yeah, that green on the screen translating into the U.S. session as well, Anna, where you are seeing futures higher by about 0.2%. 43.97 is what you're seeing on those futures contracts. To me, what's interesting, though, is the China story, because even though we are talking about inflation and the labor story, similar to the narratives you just outlined in Europe, the China story, to me, I think is really more important, given that there is a history multiple times that Chinese growth has a direct impact into the U.S. in terms of the U.S. growth story. You saw that after the global financial crisis as well, which brings me to why this Asia story is so important. We'll put some numbers on it as we do on Bloomberg TV. The 2-year yield at about 4.56, down just 1 basis point. Nothing too exciting there, waiting for the CPI inflation perhaps. But overnight, the Chinese 10-year yield, a move of 6 basis points. That is an over 4 standard deviation move, which tells you just how big of a deal this unexpected cut was. And as we talk about kind of lifting risk sentiment, copper is a great gauge of that as kind of this global bellwether. You're seeing copper higher by 1.6%, Anna, and that's certainly one commodity that I want to look at when we're talking about just how quickly recession may be on our doorstep.
Yeah, there's a lot to discuss today then, isn't there, Chrissy, from the China effects, from the tech rally that we've seen of late, from the CPI data due, the Fed meeting, UK data, what China's doing to support its economy. Let's put all of that to Peter Chatwell, Head of Global Macro Strategies Trading at Mizuho International, who joins us, not daunted by the task. Peter, thank you so much for joining us. Let's start with US CPI then, and what is at stake here. A lot of people focused on either core CPI or a sort of super core, where we haven't seen quite so much progress in bringing those numbers down. Is that going to be something the Fed watches?
I think every time an inflation report comes out, the market is quite obsessed about the trend of core and super core and the fact that they're showing evidence of having peaked and the magnitude by which headline falls. And I think that this is likely to be repeated today. And it usually lulls the market into thinking that the Fed can then translate that into some future dovishness. And I must say that I think that this is an error on the market's part, as I don't think the Fed will actually be able to deliver on the expected future dovishness that the market is pricing. And so today's data is likely to allow that to be priced in with a bit more confidence.
Yeah.
And I see that confidence as not really having solid foundations, because it's all about base effects.
Yes.
And it's about broad commodity prices, whether it's food prices or energy, having come back down to very low levels. If the economy doesn't go into a recession, those commodities are going to go up. And then we're going to be back into an inflationary environment when services and labour markets are still very tight. So we're not at the point where we can assume that the Fed and other central banks can ease off the monetary tightening.
So how wrong is rates pricing then for next year then? You don't think we're going to get these cuts?
Next year is the most egregious of the rates pricing, and the fact that we can go out to 2025, 2026, and there are no material rate hikes after that, I think is just, well, it's a gift. If you can position for that to be different, first and foremost. But also, I think it means that a number of asset classes are vulnerable to a correction if that is repriced. Now, what it comes down to is what is the interest rate cycle next time around? What is that going to be? Is that, as the market thinks, that the Fed is going to be cutting down to 2.5% and then just putting rates up a little bit, reminiscent of really what the regime that we were in before COVID? Or are we returning back to a much higher neutral interest rate environment because we're in a much higher nominal growth environment?
Well, speaking of that kind of perhaps stickier environment that you just laid out, how concerned are you about the way that a lot of these central banks are navigating it, specifically that they're navigating it in different ways? The idea that the PBOC is far more stimulative, the BOJ on pause for what seems like forever, whereas the Federal Reserve is kind of still calibrating month to month. Shouldn't all of these major central banks be on the same page, theoretically?
I understand your point about the theory, but the reason that the BOJ and the PBOC are able to take the paths that they're taking is really because the Fed's monetary policy, if you look away from the nominal interest rate, is still easy. If you look at broad financial conditions in the US, and if you take into account how well the economy is still performing, US monetary policy, I would argue, because the balance sheet from the Fed and the balance sheet from the other central banks is still so enormous, means that the economy is still being stimulated by all of the excess liquidity that's in the system. And I think the common error among central bankers is that they're not taking that into account. And that is what is leading the Fed without deliberately, but it's leading the Fed into more of a Burnsian path rather than the Volcker path, which they appear to be wanting to deliver.
Peter, talk to us then about this terminal rate that we might be looking at from the Federal Reserve specifically. About a year ago, Bloomberg Economics' Anna Wong made a call of a 5% terminal rate. And at the time, it was extremely, extremely contrary and very out there. Now we think of it as nothing. She's now making the call that in a couple of years, with this idea of persistent inflation, we might, big emphasis on might, revisit something like 10% as a terminal rate because the Federal Reserve will have to keep rates higher for longer for the exact stimulative reasons that you just mentioned. Talk to us about the repricing when it comes to the terminal rate. How much volatility do you foresee in the next year or two?
Yeah, so that's a super interesting point. And I think that I'd be broadly on the similar direction as Anna is. That I think it's the interest rate cuts for next year and maintaining them over the coming 2 to 3 years, and not really having any further major interest rates priced into the path that is causing risk assets, both equity and credit, to be really priced to perfection at this point. So although investors may feel that they're avoiding duration risks by investing in those products rather than investing in government bonds, I think indirectly they are very, very exposed to a correction of the pricing of the belly, as we call it, of the interest rate curve, say the 5-year point on the interest rate curve. So I think unless or until central bankers realise that they have to do a lot more to take liquidity out of the system, so more on QT. If they don't do that, then they're going to have to put interest rates up over the next interest rate cycle in a way that is really nowhere close to being priced in.
Okay, so we could go substantially higher then in terms of interest rates on that view. Let me come to the UK story, because of course we've got the tight labour market data. Quite a surprise, that data this morning sent the pound higher, sent 2-year gilt yields up to levels we haven't seen since the 2008 financial crisis. We're all looking at the Bank of England then. What's it going to do? It has a new member joining early July, Megan Green, giving a statement today saying that the MPC must proactively act on inflation dynamics. Maybe a little early to say what her full views are, just some more lines coming through. Some second-round effects are creeping in to inflation. So far, so hawkish, perhaps?
Yeah, it sounds it. Look, the UK has a chronic twin deficit problem, and I think that has not been registered at all in the Bank of England's forecasting toolkit. They've made a number of really quite extraordinary assumptions about a productivity boom in the UK economy, and they seem to not really have the current account deficit factored into their model. They have admitted that their inflation model is something that they're not really following now. And I would think that they really need to have a look at monetary trends, monetary aggregates, and to incorporate those into their forecasting model, and also more of a global view. If they do that, then I think that they'll see that the UK is probably going to need to run a persistently higher interest rate, excuse me, to compensate for the twin deficits that the economy and the next government are likely to be continuing to run.
Okay, Peter, thank you very much. Thanks for joining us. Peter Chatwell of Mizuho International. Coming up, we will get you more analysis on a busy week ahead for markets. We, of course, have yet to hear from the Fed. We've yet to hear from the ECB, the BOJ, and we've heard from the PBOC, but might we hear from them again? More on that coming up shortly. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Surveillance Early Edition. I'm Preeti Gupta in New York with Anna Edwards in London. It's a busy week with U.S. CPI coming out today in just a few hours, and the Federal Reserve rate decision coming out tomorrow. Joining us now, Bloomberg International Economics and Policy Correspondent Michael McKee and Bloomberg Markets reporter Valerie Teitel. Mike, I want to start with you here. Simply the idea of the commentary that you are seeing in kind of these economist notes and strategist notes, which is that inflation is going to be higher for longer, that this is a persistent story, one of the Fed's favorite buzzwords, yet the market is pricing in some sort of return to normalcy. What could the Federal Reserve have to say about that tomorrow, taking today's data aside?
Well, they're going to take a cautious view, and I think the consensus is narrowly on the side that they will skip a meeting and see what's happening with the economy, because they have raised by 525 basis points over the last year, and all of that hasn't hit the economy yet. We are seeing inflation come down, but as they frequently remind us, if you go from 9% to 4%, that's great, but 4% is still double what the Fed's target is. And at this point, they're looking at that 4% to 2% that they want to get to as much more difficult, because that's the embedded inflation. We've seen the energy prices go away and service prices went up and they're starting to come down, but there's embedded inflation in there, and they're trying to figure out how much of that is wages and how much of that is just price taking. And so they're going to stay firm on inflation, and they're going to say we are not giving up until we get to 2%.
Okay, so they're sticking with their inflation focus, as we might expect. Valerie, given that, what matters about the CPI data? Does it matter, I could ask, or maybe does it matter as much as it has mattered in the most recent months, given what we know about the Fed's intention or wanting to skip this time around?
No, look, it's a good question, Anna. The market is really quite split on the answer. You have many prominent Fed watchers who say, that the Fed has really over forecast this pause in June, just tomorrow, that they're not going to change their mind just on one hot data print, because frankly, they haven't changed their mind on the month of hot data that we have had since they last met. And then the other side of the camp really wants to take this extreme data dependence, the words that Powell says quite literally, thinking that we could just be one more hot print away from really putting that Fed pause in doubt. And I'm not saying that a beat today would make us price that in officially, but it could get the market to hang out somewhere near 50-50 in June, and that's not something the Fed wants to see the day before its decision.
Valerie, talk to us about the trade here, the trade at play. We're looking at a two-year yield that's getting closer and closer to 5% every morning that I check it. Is the trade as simple as if you have a hot CPI print, you sell bonds? Is that as simple as it gets?
Oh, I think it's going to be way more complicated than that today. To me, the bull case seems a bit more clear in equities. You have to take into account, again, we've had all this hot data, and you haven't had the Fed pull back on this decision to pause in June. That puts a lot of this data dependence maybe in question, right? If they don't hike tomorrow after a hot print today, the market's going to start to believe they're not going to be hiking ever again, and this is the end. And that's pretty positive for equities. We would take out some of what the front end is pricing, and the dollar would soften.
Okay, so we'll watch for that. Mike, let's put into the conversation a bit of Fed thinking around surprises or not surprises, because last week we got a few surprises from some global central banks, from the RBA and the Bank of Canada. They both surprised the markets. The point has been made a number of times that the Fed just simply does not like to surprise the markets. How is that factoring into your thinking about what they do from here?
Well, I think that's why I would lean towards the idea of a skip, because they don't like to surprise the markets. They've learned over the years that it's better to guide the markets. However, in this case, the Fed is so divided that the guidance is kind of all over the place, and so it isn't completely clear what they're going to do. So I think they come out of it by maybe skipping, but giving us an indication that they're likely to raise rates in July if the inflation rate and the economy don't slow down a little bit. And that'll probably bring most of the members along with it, and they'll probably get maybe a unanimous decision, or maybe with one dissent. But they're going to have to frame this to take in both sides, which is something they haven't done for a long time. And I got to tell you, I've been doing this for 30 years now, and I have not seen a meeting in a very long time where the outcome wasn't already baked in. I always come to these appearances on television and say, well, it's what they say, not what they do. But in this case, it could be what they do.
Well, sticking with that concept of kind of the international banking story, how much does the Federal Reserve need to factor in what the PBOC is doing in terms of stimulus, and then just simply the Chinese growth story as we talk about just how much that feeds through into the U.S.? Is China, at the end of the day, exporting deflation?
At this point, China is a minor player in what's happening in the United States, and it's probably going to remain that. It depends on what kind of growth the Chinese get. It looks like at this point they're trying to stimulate domestic demand, and if they stimulate domestic demand, and they've also moved towards a lot more domestic supply, then the money is going to basically, to oversimplify, stay in China. If they're not buying a lot from overseas, and of course we're cutting them off from a lot of technology, then it isn't really going to matter as much to the U.S. One thing that's been interesting is that throughout this period of tension between China and the U.S., and to a lesser extent the Europeans, the export levels to China from the U.S. and Europe have remained the same or gone up. So they're still buying stuff from us. It hasn't fallen off yet, but it isn't going to make a big difference to the Fed going forward.
Valerie, Michael, thank you very much. Thanks to Michael McKee. Thanks to Valerie Teitel with the analysis of the data and the Fed's decisions still ahead this week. Coming up, we will bring you our exclusive interview with the CEO of Barclays, CS Venkatakrishnan. We will bring you highlights from that conversation shortly. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. The CEO of Barclays says leadership changes at the firm's investment bank and new growth strategies have contributed to higher than usual attrition in recent months. He spoke in an exclusive conversation with Bloomberg's David Weston.
We're losing a few investment bankers, but not that much more than what is normal annual turnover. I mean, this is the period in the first few months of the second quarter when people have been paid their bonuses and there's a little bit of musical chairs, as you know. It's a time-honored tradition in this industry. We made a management change in our investment bank. We spent a lot of time last year thinking about what we expected the banking landscape to be over the next decade. So what you've seen is rising interest rates, changing business models, the importance of sectors that are fairly new to the economy, not just technology, but sustainability, mobility, climate tech. And then there is just the different players and the importance of the players in the banking market. The private equity groups have been very large. Private credit funds are becoming bigger. They're slightly disintermediating what banks are doing. And as we began with a very American investment bank here in the US, based from the Lehman acquisition of Barclays, and we've grown in Europe, we wanted to put more emphasis in Europe as well. So you bring it all together, and you're talking about us thinking about the next generation of leadership of the investment bank. Building on our strengths in debt capital markets, but growing in equities, growing in M&A, growing in Europe. And when you do that kind of organizational change, sometimes it has impacts.
Well, you suggested something I was curious about. Is there a strategic shift in emphasis in the investment bank a little bit away from the United States and toward Europe? Because as I recall, your two co-heads before were based in the United States. The two co-heads now are going to be based in Europe.
One is in Europe and one is here in the US. So it's not a shift so much as an expansion. It is to try to give more attention to Europe, relatively speaking. The US remains critically important to us, and the US businesses are some things, especially in the debt capital markets, where we are absolutely leading, and we want to maintain that position.
An exclusive interview there with the CEO of Barclays. Now, let's take a look at some of the things that are ahead for us in the trading diary. US CPI data coming out at 8:30 a.m. Eastern Time. We've talked about it a lot. That is going to be the focus of today. 4.1% is the number to look for in terms of the year-on-year print. Exclude food and energy, 5.2%. Then that's going to be closely followed, of course, by the FOMC tomorrow, which is why this matters so much. And they start their meeting today. Also at 10 a.m. today, US Treasury Secretary Janet Yellen testifies at the House Financial Services Committee, while in Miami, Donald Trump is expected in court later today. Chrissy?
Yeah, and of course, some of the micro stocks to be watching as well. We'll throw those at you as well. Oracle at the top of the list, Anna, hitting that record high is coming after the AI story, spurring that cloud demand. This is a really big deal for a name like Oracle, which doesn't have the cloud market share that its peers Alphabet and Microsoft does. This could potentially spearhead them into the game, higher by about 4.4%. We want to take a look at some of the big tech names as well, Apple and Microsoft. Apple falling, UBS downgrading them on services growth slowdown, saying that their iPhone sales could hit about 1.2% lower in the back half of the year. Microsoft, on the other hand, gaining about 0.6%. That coming off the FTC saying maybe the Activision deal isn't such a good idea. It's a little bit of an M&A trade in reverse. And lastly, Anna, Carnival Cruise Lines higher by 4.3%. Some of the big banks saying the industry has momentum.
Okay, lots to focus on then ahead of the market open. Of course, we'll focus on the CPI print a little bit later. Still watching lines coming through from Megan Green, who is going to soon be appointed at the Bank of England. That's moving markets a little. That is it for Surveillance Early Edition. This is Bloomberg.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
This is Bloomberg.
It's extremely difficult for the central banks to get a handle on just where it goes from here.
The data supports that things are weakening, and I think the Fed's going to pause.
Usually when you got a Fed funds hike cycle, of course, equities sell off.
Wednesday could be a landmine if they sound more hawkish than expected.
This is a Fed that doesn't like to surprise. Unless the CPI numbers are just absolutely wild, they're not hiking this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
CPI Tuesday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by a little more than 0.1% on the S&P. We are about 2 hours and 30 minutes away from some important economic data in America. Then it's onwards to the Federal Reserve and Chairman Powell, TK, tomorrow afternoon.
Markets getting out front. The markets lift yesterday. They lift today. It seems to be a celebration of a tilt to a better core statistic. And I would say maybe more than ever, it's not CPI Tuesday. It's core CPI Tuesday. Everybody focused on the basics of what's out there in the economy, and the tone is constructive.
China Stimulus Tuesday as well. Fantastic reporting from the team here at Bloomberg on the latest in China, considering a broad package of stimulus measures as the pressure builds on the Chinese government and Xi Jinping to support this economy. This, Lisa, according to people familiar with the matter overnight.
Here's my issue with this whole story, which is, are they trying to stimulate or are they trying to support from some sort of significant deceleration that's more protracted? I don't have a sense of that, because we're still seeing that 5% target, which is somewhat conservative.
Surveillance out front. We try to do this, folks. Sometimes we get it wrong. Sometimes we get it right. Ian Shepherdson with us yesterday from Pantheon, and we talked about his colleague Duncan Wrigley's work on China. It's been brilliant. And boy, did they nail what you just said, Lisa. They say this is not a major stimulus. This is a limited, narrow effort to salvage subpar growth.
So let's go through the proposals, the reporting, and then I'll get you some opinion. So at least a dozen measures being proposed, considered over in China at the moment, designed to support areas such as real estate and domestic demand. Those measures include the potential for interest rate reductions. Here's an opinion for you. Marko Kolanovic over at JP Morgan publishing yesterday afternoon, any China stimulus is unlikely to be meaningful. PMIs could converge, but with services coming down towards manufacturing in the second half. We heard from Mislav Matejka at JP Morgan yesterday morning as well, saying something very similar. They're on the same team. Ultimately, they think any hope that China is going to outperform, pick up in growth.
Do a 2008.
They're pushing back pretty hard.
Yeah, I'm seeing that throughout a lot. What I would suggest, Ala, what Ian said yesterday is this is where you get rates down there on subpar growth, and then you begin to ask, will we disinflate in China and bring that disinflation over to ebb any inflation worries in the West?
Got to talk politics this morning as well, TK. We'll talk about CPI, what it means for the Fed. We'll talk about the prospect of China's stimulus. We've got to talk about the president, TK, heading to court.
extraordinary. I really don't know what to make of it because this is so original. To our international audience, you're going to have lots of people, bow tie or not, trying to pontificate about where this places in American history. I would suggest no one does. It's an original moment for the nation.
Katie Lyons on the ground in Miami. We're going to catch up with her a little bit later this morning, together with the rest of the team in D.C., led by Bloomberg's Anne-Marie. Look out for those conversations through the morning. 2 hours, 30 minutes away from that economic data. These are the scores right now, the way the stage is set going into that information a little bit later on this morning. Equity futures positive by 0.1%. Yields come in just a touch, but barely changed this morning at 373.18 in the FX market. Euro just a touch stronger. I've got to say on the session, Lisa, here, 108.05. And just to finish with crude, trying to get up off the mat. Yesterday and the last couple of weeks hasn't been great for crude, has it? Pullback continues, trying to bounce by 1%. On a session, $68 at the moment.
You definitely categorized that correctly, trying to get off the mat after a pretty significant underperformance, even after with those supply cuts. We're looking today, 8:30 a.m. Eastern, that is the U.S. CPI print for the month of May. As Tom was mentioning, core CPI really is the key metric. It's supposed to come in to about 5.2% year over year from 5.5%. This driven by rents. We are seeing rents decline in certain areas in the nation overall, are decelerating at the fastest pace going back years. How much does this support this feeling that a skip, a pause could happen and then be protracted? At 10 a.m., U.S. Treasury Secretary Janet Yellen is testifying in front of the House Financial Services Committee. She's going to be talking about why the U.S. should support the IMF and World Bank to counter China's Belt and Road Initiative and all that entails. And at 3 p.m., Trump is expected in Miami federal court at 3 p.m. Very curious to see just the public response to it, the security, what kind of drama there is out of the courtroom. Because in the courtroom, it's just the initial salvo of a long, protracted process that we'll find out more about.
What a moment for this country. Plenty of coverage of that just around the corner. Let's start the conversation around the market. Jonathan Stubbs, equity strategist over at Berenberg, joins us right now. John, we're having this broader conversation over the last couple of weeks as to whether this equity market rally, year-to-date dominated by mega-cap tech, can broaden out. Do you still like the small caps? And if so, why do you like the small caps, John?
If you follow signals and if you follow valuation, US small caps, as the S&P 600, trades under 12 times on a median stock basis, S&P 500 on 17, 18 times on the same basis. And that gap we've only seen twice before in the last 30 years. Once was 2000, many people remember that. Once was 2020, most recently. Both of those were excellent near or long-term, respectively, buying opportunities for small caps. So valuation and the signals we've seen over the last 25 years tell you to do one thing here, and that's to buy small caps. Again, that's pretty contrarian given to market moves over this year, although we've seen some reversal year to date. So if you do think valuation is important to drive or support returns over the medium term, we've got a valuation signal here, and that's telling you to buy US small caps despite softening of economy ahead and despite the strong leadership we've seen from a very few stocks in the US year today.
Jonathan Stubbs, I love it's too early to do this, John. It's way too early in the morning to do the math of it, but you push aside 60-40 as a traditional 60% equity, 40% bonds. You've got a 40-20-40, which is 40% equity, 20% bonds, and 40% based on liquidity. Is that play done now? So what's next? If the VIX has come in with the drama we've seen, what's the new Stubbs allocation?
Yeah, I mean, when I started here at Berenberg in 2020, I wrote the 60-40 was not appropriate to sort of hedge the post-COVID world with inflation risk, etc. Members of Treasuries, 10-year Treasuries yielded 50, 60 bips, summer 2020, and went to a very sort of unconventional asset allocation framework, which had a very long tail exposure to real assets, alternative assets, which is in that sort of second 40 you mentioned, and also to a liquidity hedge, trying to find a combination of assets that provided investors some protection against world risks, against black swans. And in that bucket, I still have Bitcoin, which is controversial to many. I have cash, and also have gold. And I think that's still relevant because there are lots of uncertainties. You're talking earlier about sort of political history being made in the US this week. We've now got politics being very explicitly weaponized. I think that must bring into question the risk premium that investors globally attach to to the US, to US assets, whether that's the dollar interest rates or asset classes. So, I think running asset allocation with eyes closed these days is not an option. I think eyes need to be wide open. And I think adding legitimate protection is the best way of approaching these markets for a variety of reasons.
What does it mean to have your eyes open if you have underperformed, if the assets that you've had faith in haven't really delivered, and the rest of the universe that perhaps have fundamental reasons for why they should sell off continues to outperform and even add to that? What do you do?
Yeah, I guess it depends what you're trying to do with capital. I mean, high-level asset allocators, capital allocators are trying to deliver a real return, protect capital in real terms, and you don't need to be the best performing asset class to deliver that. So, we're still recommending a 40% weight in equity, and in that equity sleeve, we're recommending strategies such as defensive growth or quality at a reasonable price, fiscal alignment, which is owning industries or companies that align with very sort of strong narratives from governments, which gets you into sort of cyber, into defense industries, into infrastructure. So we do bring that into it as well. But overall, we're trying to look at a balanced package that presents a good opportunity to deliver real returns.
John, excuse me. I walked in the door. SPX 4,400. That was what futures said. Give me your S&P 500 a year out.
Yeah, if you look at measures, if you're sort of top down first, which I am, you look at all these signals coming from margins, from the yield curve, and a year out we may be at sort of similar levels or slightly higher, but it does suggest that we're going sort of significantly lower between now and then. Alternatively, you have to scrap everything that we've learned over the last 10, 20, 30, 40, 50 years and construct a very new forward-only looking narrative. And you have to say that we're living in a time of captured markets where fiscal underpins everything, supported by monetary, and we're going into a world where authorities effectively remove free markets from what we've been used to, and you can construct a very reasonable bull case for equities, I think, on that basis. But you have to assume that we're not living in an environment of free markets.
John Farrell, did we get an answer from him?
I think there was something about central planning being good for
4,500, or come on, I need 4,600 out of you, Jonathan.
We're selling rallies and buying dips. That's what we've been doing since the start of this year. We think we're sitting towards the top end of a very strong rally, which has been great for the market.
Yeah.
If you look at the technicals here, the technical setup is not to add aggressively at this point. Look at sentiment. Sentiment in October was telling you to buy markets aggressively. Sentiment now is not telling you to do that. So that's the warning sign out there for investors.
We were right to buy the post-SVB dip, that's for sure. That's paid off. Jonathan Stubbs of Berenberg. John, good to see you, sir, as always. TK asking about index price targets on the S&P for year-end. Yesterday evening, I was just summing it all up. Some of the moves we've seen over the last couple of weeks. RBC made a move. May 21, Bank of America new year-end price target 4,300 was 4K. Early June, Evercore 4,450 was 4,150. Goldman going into the weekend, now 4,500 was 4,000. 4,000 was where the center of gravity was, Tom. And as we get further and further away from it, I think the upgrades are starting to come through for the mid-year outlooks.
For TV and radio, I can't do this. It's too technical, but it is the Bloomberg terminal. It's a thing called ADX DMI. And John, it's a lot of fancy calculus. It's actually really, really magical technical studies on the Bloomberg. Here's the answer. This is not about people buying, John. It's asymmetric. This rally is about a dearth of sellers. There's a difference. It's not about, OMG, I got to own Apple. It's, I'm not selling Apple. There's a difference.
Well, I think there's certainly been a bit of we've missed out. I think we need to pile into these names, Bramo, over the last few weeks.
We're hearing that more and more. This has legs. It's AI. It's something that's more sustainable. Forget interest rates.
It's a bull market.
Exactly. Here we are.
It's a toxic brew of optimism.
A toxic brew of optimism. These bull markets, Tom, I remember a headline you wrote a long time ago. I brought that up recently. Most hated bull market ever. These bull markets over the last 10, 15 years, all these rallies are just despised.
It is criminal how the public has missed the greater bull market because of overthinking. Criminal. That goes back to Roger Ferguson.
Well, that goes back a long, long time.
Yeah, Roger Ferguson of TIAA-CREF and the Fed is very articulate.
Scarred by your trading days in the 30s. I know. Equity futures on the S&P, positive by 0.1%.
Cigars.
Inflation data. They were the days.
Scotch,
a few hours away.
Bottle of scotch in the drawer.
Keeping Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. There are more signs that China is increasingly concerned about a slowing economy. Bloomberg's learned that Beijing is considering a broad package of stimulus measures. Meanwhile, China's central bank has unexpectedly lowered a key short-term interest rate. The latest U.S. inflation figures come out today, and Bloomberg Economics says the data are likely to give support the Federal Reserve officials wanting to put their tightening campaign on pause this week. It's estimated that core inflation rose 0.3% last month, a slowdown from April's increase. In Miami, police say as many as 50,000 people could turn up when former President Trump appears in federal court today. He's expected to plead not guilty to charges involving the mishandling of classified documents. Trump loyalists have promised to show force. France's President Emmanuel Macron says he hopes Ukraine's counteroffensive is successful and will lead to negotiations. Macron and the leaders of Germany and Poland met in Paris. They discussed coordinating military assistance to Ukraine and the upcoming NATO summit. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Wednesday, will the Fed pause or hike?
The steepest tightening cycle since the 1980s may be about over.
It's a we've never been here moment.
And where will they go from there?
They may leave the door open to additional rate hikes.
They say pause and this market hears cuts.
Trust Bloomberg for the fastest coverage and exclusive analysis.
What could potentially torpedo this?
You're not really seeing the slowing in the labor market.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg, your global business authority.
I always want to make sure that we have a fair process. And what's really concerning to the American public, that it really seems like one side of justice is being weaponized.
What about those pictures? Was that a good look for the former president to have boxes in a bathroom?
I don't know. Is it a good picture to have boxes in a garage that opens up all the time? A bathroom door locks.
Oh. House Speaker Kevin McCarthy there.
The Bramo can caught an exclamation there.
Bramo not too impressed with that exchange. Perhaps she can reveal why in just a moment. Your equity market on the S&P 500 shaping up as follows, going into CPI later on today. Equity futures up by 0.1%. Yields unchanged, 373.57 on a 10-year maturity. I want to go straight to Apple, closing at a record high in yesterday's session. Just a touch softer today. UBS making a move, moving to neutral. Cutting the outlook for Apple. They say softer iPhone and services growth. Apple trades at 29 times our near-term EPS estimates, above next 12-month estimates, above the 1, 3, and 5-year average, Tom, of 25, 27, and 23, respectively.
They had their developers conference, and there's some quibbles there about this box or that box, but the answer is just life goes on for Apple. And as they approach $3 trillion market cap and the vector that we've seen, at least since the October lows, you have to say of Apple, they just continue to grind out what they do. Mr. Cook says to build the ecosystem, the number of people involved in this each and every day.
Quite a run, though, TK. All-time highs. What are we up now on the year? 30, 40%?
Yeah, my quick math a week ago rather, was 191 is 3 trillion, and we're at a 184-ish, 83-ish.
Up 41% year to date.
Yeah, and
it's quite a run.
It's quite a run, and it's lesser than the NVIDIA's.
Check out NVIDIA, I was about to say.
Yeah, well, there's
up
others.
100 plus, Meta too.
Yeah,
I'm with you.
And this is important. And we got to get to the work on the former president, but this is important. Apple's under-owned by institutions. You know, it's an unloved stuff. People don't want to buy it to the size of its impact on the market.
Amazon up 50%, also under-owned. These names just got battered last year. Big tech had a really, really difficult time, and the bounce back has been severe.
Do you need new iPod thingies, whatever they call them, to go to camp?
No, mine are pretty decent. I don't go to camp
debate
either.
at home.
Do you camp?
Well, you got to go to camp, summer camp. You got to have some new Apple stuff. I'm not camping.
Okay.
I'm writing the check. I mean, it's, you know.
You've got to mute your terminal there, Tom, too.
Oh, yeah.
Messages popping.
I didn't do that. Somebody else did it here.
Okay.
It's okay.
You can mute that. That would be great.
There it is. It's very loud, actually. Right now, in Miami, seriously reading in on this historic moment for the nation. We're going to get to Wendy Schiller of Brown University. But first, Kaylee Lyons in Miami. Balance of Power, of course, with their complete coverage this afternoon. Kaylee Lyons, what will you observe today of the judge at this arraignment?
Well, we won't actually see the judge or President Trump inside the courthouse for that matter, Tom, because cameras aren't going to be allowed. And frankly, we may not even see the former president walking into the courthouse through the lobby. Instead, he's expected to enter through an underground tunnel. What we know, though, is that once he is inside, he will be arrested by authorities and then processed just like anyone else who is facing federal criminal charges. He could have his fingerprint and mugshot taken, and then he will go up to the 13th floor and appear before that judge, and we expect him to plead not guilty to these 37 counts of 7 different federal criminal charges. And of course, that is what makes this moment historic. No other former president has ever been charged of a federal crime, even though he has been previously indicted, as we saw in Manhattan. Earlier this year. And of course, after all the proceedings here in Miami today, he's getting back on the plane, heading back up to Bedminster, New Jersey, in his golf club there, where he will address supporters at 8:15 p.m. Eastern time and hold a fundraising event for his 2024 campaign. The campaign expects to raise $2 million at that event tonight.
Long day for Kaylee Lyons, and we'll see where that goes tonight with the president speaking in New Jersey. Right now, and this has been just a joy for us over the recent weeks, Wendy Schiller joins as director of Taubman Center, Brown University. Wendy, we're squeezed for time today. Let's just cut to the chase. It is truly an original moment. This is not in your classic textbook. How will you place a new chapter into your textbook?
Well, in some ways, I think that this is a development for the democracy. And if you're a Trump supporter, you say, oh, this is terrible and it's a political witch hunt. But if you think about it, why should presidents be shielded from behavior if it's criminal, whether it's federally criminal or breaking a state law, when they're president? I mean, they should be held accountable. This is an evolution of where we are. Latin America, we know, oh, you know, we don't want to be like them. But even Europe now, Nicola Sturgeon was held just the other day, you know, former leader of Scotland, for things she might have done or her husband might have done for their party. You know, democracies have to have a rule of law. And if you let the most powerful operator in the democracy break the law because they're insulated from prosecution when they're president, they're probably going to do that. And that's not something I think we want in the 21st century. So I'm not as perturbed or disturbed by this. I don't think it's a political witch hunt. I am concerned that when Democrats get out of office, the same thing will happen. But there is a rule of law. And if you break the law, you need to be held accountable.
There's the prosecution, and then there's the response publicly, where people who are for the former president are still for him and do believe that this is some sort of undermining of the institutions. What's your takeaway from that when you teach your political history classes at Brown?
Well, I mean, political loyalty has turned into, very fierce support and sometimes violence in the entire history of the country. That is not new. We have to see what happens today. How many will come out and go to a rally in the, not that hot weather, we think maybe in Miami today. But is that the same as, committing violence or trying to upend the system entirely just to save this one person? It's a larger problem for the Republican Party going down the line. They really, in the end of the day, McCarthy's answer was quite weak. There's a bathroom lock. There's a lock on the bathroom door. That's, this is the Espionage Act. These are military secrets. Is this man capable of being entrusted with national security? That becomes a larger issue as this trial proceeds for the Republican Party and those other people running for office in 2024 in the Republican Party.
Putting aside Kevin McCarthy's response, you can come to whatever your conclusion that you'd like to come to that. There is an issue of at what point Republican nominees or potential nominees start to push back against what former President Trump is facing up against, or starts to put a little bit more credence in the judicial system. Do you expect that to be the case, or do you think that there will continue to be support and import around backing the former president and really kind of sticking with that line?
Well, Lisa, that's the very important question, and we have to ask ourselves over the next couple of months. The question is, in the polling, they've got to win the primary. I mean, this is the most devoted Republican voters, but a lot of independents in some states with open registration vote in the Republican primary. They maybe voted Republican before Trump. They've left Trump in majority numbers in the last couple of years, but will they vote in Republican primaries? And if independent voters do that, right? They vote in Republican primaries. They're not going to want this guy. And how do you balance that? And then, of course, in the general election, we know they're not going to vote for this guy. So this is the big question for those other people running. You don't want to alienate your core base of Trump supporters. On the other hand, other people vote in those Republican primaries too, and they're just going to get sick of this, especially if there's a Georgia indictment or January 6th indictment.
Yeah.
This guy just becomes too much of a liability. And then you risk losing turnout in 2024 among that base for Republicans.
Wendy, I have 30 seconds. What kind of legal representation does the former president have today?
I think they were scrambling as of yesterday, so I'm not even quite sure. But then you have to ask yourself that question, too, is at what point does he lose the capability of getting the very best minds in the country to try to defend him? And let's not forget the judge. This judge sort of got in trouble for the way that she handled this case earlier in its proceedings. What does she do now? And does she continue along that path, or does she sort of more conform with regular judicial standards in the federal judiciary?
Wendy Schiller of Brown University. Wendy, we'll be talking soon, no doubt. TK, that is the question, isn't it, this morning?
Nailed it. You nailed it. I feel remiss I didn't bring it up earlier. To me, it's the most important question, having nothing to do with politics. Any individual in court, particularly if they have means, should be entitled to the best legal representation. Clearly, that's not the case this morning for the former president of the United States.
It appears he's struggling to find it.
For whatever reason, it may be self-inflicted. It's not for me to judge. It's an outrage that we're having this conversation. You nailed it by bringing it up, John.
Equity's just about positive on the S&P 500. From New York City, this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
3-day winning streak on the S&P 500 coming into today. Can we make it 4 in the equity market? S&P 500 futures look a little something like this. Futures positive by 0.1% on the S&P. On the Nasdaq. Outperformance on the Nasdaq all year. Underperformance month to date on the year so far, though. Yesterday, adding some more weight to the rally. The Nasdaq 100 up year to date, Tom. 35%.
Just quick review here of what we talked about before, the fancy technical mumbo jumbo. There's just nobody selling. I mean, it's just all there is to it. And I saw it yesterday, NASDAQ up, pull back, hang out for an hour, up, pull back, and then a nice pop at the end.
It's a great description of the session, TK.
Well, it's very technical, you know. 44, and I walk in, the first thing I see on the Bloomberg terminal, SPX index, 4,400. I couldn't have framed that 4 weeks ago, let alone 4 months ago.
4,500, the new forecast at Goldman. Is it bullish enough? Sentiment's changed. They're the kind of questions that people are asking, and no doubt things can change just as quickly in the other direction. A lot's changed in the equity market. Not much has changed at all in the bond market. The 2-year, I was looking at the scores year to date yesterday evening on a Bloomberg terminal. The 2-year on the year is up by something like 15, 16 basis points. Tons of volatility in between, as high as 5.08%, really low post-SVB. We were talking about hard landing, credit crunch and all that stuff, all that bad stuff. And we get further and further away from that. And we start to think about a Fed that can pause and maybe even hike once more. In the FX market, are we about to get whipsawed by China's stimulus and a stronger euro again? We reclaim 108.01 on a euro. German investor confidence, not dreadful. A little bit earlier, TK, you throw in our reporting that China might be considering stimulus, and all of a sudden, you've got a stronger euro again.
So China's stimulus, lower interest rates, which means weaker yuan, and you see that reaching the goal of many people, which is from 7.00 to 7.15. And Stephen Englander, I believe it was yesterday at Standard Charter, framing out 7.30 is an ever weaker yuan.
We've had the China reopening. We've had the energy scare and come out the other side in Europe. There were reasons to buy that story because it was deeply depressed coming into 4Q last year. And Tom, now you're looking for a new engine of growth in this market. Where does that come from? I think the fact of the matter is we are halfway through the year and we're talking about stimulus in China when we should have been talking about, and this was the consensus view at the start of 2023, we thought we'd be talking about China just booming on the back of a reopening. And here we are talking about rate cuts, measures to support the housing market, the broader economy, the government under pressure. That's a real turn, a real change relative to what we expected 6 months ago.
Quickly here, Lisa, where are you on this? I mean, where I am, as John says, we're halfway through the year. I feel like the year's been 14 months long. It's like June, and it feels like November.
It's just been continual whipsaw and a lack of uncertainty.
Exhausting.
And even within specific regions, they're bifurcated kinds of recoveries. And within the U.S., certain states are doing better, certain states aren't. So, Tom, I think to that point, it's hard to get a handle on the overhead, top-level view of the economic picture.
Let's solve that right now with Janet Henry, Global Chief Economist and head of the top-line view at HSBC. We're thrilled she could join us this morning. Janet, I want to blend together this central bank derby that is upon us here with the China news. And this is where the Hong Kong and Shanghai Banking Corporation has a real ability. And that is, if we see a troubled China, a disappointing China, will we import their challenges? Will we import their disinflation?
Not immediately. You're right, relative to, I suppose, the consensus view earlier in the year, when there was a huge amount of optimism regarding China and reopening, and some people got very excited about the idea of unsynchronized growth, that China would lift Europe and they would both rebound as the US went to the inevitable hard landing. And the truth of the matter is the US has already been more resilient. China has not had the explosion on reopening. Remember, this was the second reopening, and it's now clear that more stimulus will be required to continue the recovery. So I don't think, given that we're not getting the same trade channel, that world trade growth is already very weak. Even US and European import growth is not strong. There's not the same deflationary influence. And while we have seen commodity prices perhaps be a little bit weaker than many anticipated, and in fact, they're probably half their peak levels, remember, they're still a lot higher than they were back in 2019. So I don't think it's quite as clear-cut that suddenly China being weaker poses deflationary influences to the global economy.
You must have read my script, because that's where I want to go. Folks, I just looked up quickly here. The United States Department of Agriculture, the USDA, and their guesstimate for inflation of food this year in the United States, and it's banded roughly 5 to 8%. It's much worse, Janet, for many parts of Europe. Are you beginning to see, on this core CPI Tuesday, are you beginning to see among the central banks a lessening of food inflation?
You are, but so far it's interesting where you're seeing the biggest drop in headline inflation. It's actually been more in the emerging markets. So everyone's seen the energy inflation come down, and where you've seen bigger reductions in food price inflation, it's been more in emerging economies. And I think part of that is because in emerging economies, whether it's in Latin America or in Asia, they buy more fresh food. A lot of what we buy in the West is packaging. Let's not forget that, and labor costs. So I think we are going to see some easing of food price inflation, but remember, it's still running at close to 20%. And when we think about going forward, we're still going to have volatility on inflation. We have good harvest in Brazil, and then we hear about really bad harvests likely in Australia. So it's the volatility of inflation. And remember, for producers, they're not going to move with every monthly change in wholesale food prices. Janet, we're about 2 hours out from that key CPI print in the U.S. We are looking at a lot of central banks, including the Australian Central Bank, including the Canadian Central Bank, and now potentially the Bank of England after that incredibly and surprisingly hot labor print that we got earlier this morning. What's to say the U.S. isn't facing the same inflation dynamic that the U.K. is, that Australia is, that Canada is? Well, it is facing more resilient growth, but where some of the key differences are so far on the US versus the others, and in particular the UK, is clearly on the labour market. When you're getting wage prints around the 7% level in the UK, and remember, this is an economy that really hasn't grown for the last year, the labour market is still surprisingly strong, and the wage releases, workers are clawing back higher pay rises. And clearly what Chair Powell has been telling us in the last couple of months, there are certain elements of the US economy that so far are different. Doesn't mean they will continue to be different, but it is highly unusual that you see pay growth having slowed from just under 6% to just below 4.5%, still not consistent with 2% inflation, but to even move down without any rise in wage growth means that the inflationary pressures are somewhat different in the US than the UK. And obviously Australia's got a lagged wage market story and has got some more rigid wage setting procedures as well. So the US has got an inflation challenge. I don't think the fight is over. I still think they probably will raise rates again, although clearly not in June.
They told us that, but I think that the Fed isn't done, and I still don't think it's going to cut rates quickly. It will be closer to the middle of 2024 before we see a rate cut from the Fed.
One of the reasons why this is one of the most confusing periods economically is because you mentioned that figure of where wage growth has come down, and I wonder how much is that compositional? How much is that because some of the people who are getting wage gains are on the lower income sphere, that there's been a white-collar recession? How much is this a compositional story more than anything else that makes it incredibly difficult to even look at some of those overarching numbers?
Well, very good point, because actually, if you look at the lowest paid sector in the US, it is leisure and hospitality. And for a period, without a doubt, it had the strongest wage growth. It was about the only sector that didn't see a real wage squeeze, because for a period, they were getting pay growth of over 15% or so. But in the US, wage growth has slowed in nearly every sector, but you're absolutely right. It's been in the information sector where you have seen a recession that you've seen the most jobs lost. There is a compensational issue, but you've got divergences in other economies as well. The UK release today was quite interesting. The strongest growth in employment was actually in real estate, ICT, and finance, not the jobs.
You went right where I want to go, Janet.
Lost in the US.
I love it. You went right where I want to go. I'm asking this for John from Coventry, okay? It's real simple. What's the Brexit effect on inflation and growth in the United Kingdom? I don't see anybody really addressing that. What's the Brexit effect? Thumb up or thumb down from Janet Henry?
I think it's fair to say that the Brexit impact on the UK economy has been to contribute to lower growth and to higher inflation. Can't give you point estimates at this point. A lot will depend where we go from here. But so far, it's been on the supply side of the UK economy that we felt the impact of Brexit. And yeah, I think that's as much as we can say at this point.
Janet Henry of HSBC, very diplomatic. Janet doesn't want the hate mail. TK. That's what that's about.
Chancellor's watching. She knows. I mean, he watches
Janet, thank
every morning.
you. Wonderful. Elise is right to bring up the data. We've had double-digit CPI in the UK. It's pulled back, but it's still close to 9 at a headline level. And a wage growth story this morning out of the United Kingdom, really, really punchy stuff. We're talking about 7 handles, 6 handles. And Lisa, I'm looking at the projections for the Bank of England now. And we had this conversation here stateside about the prospect for 6 on Fed funds.
Yeah.
That's the conversation on Threadneedle Street and for the City of London this morning, the prospect of maybe getting out somewhere to 6.
And we're talking about a much more stagflationary kind of environment because other areas' growth is slowing, although still better than expected. How do you understand this? Is this structural change to a labor market just in the UK, or is it global? Because we're also seeing it in other European nations. We're also seeing it with an aging workforce. This is why it's such a tough moment to get ahead.
Two things quickly here. We aggregate central banks, and boy, are they all different. Every nation's different. Every economy's different. But I would suggest, John, I defer to you on this. The polarity in the United Kingdom from a prosperous service sector dynamism of London and other geographies you know better than me versus a United Kingdom flat on her back is I would suggest, it's different, but as stark or starker than in the United States.
Well, you know me, TK, I'm probably the worst person to ask that question to because I have a long-only bias on the City of London. I'm so bullish on London and always
I agree,
will be.
And
I sit here and I've sat here for a long time and I hear people come over and say, oh, yeah, the UK, isn't it bad, isn't it bad? Then I land in London and Tom, it's booming. I get to the city and it's doing great. And I see everyone who lives there and they're enjoying it. Reminds me of Switzerland. I remember in Switzerland, I talk about this a lot. You'd go over to Zurich and you'd see all these blacked out luxury vehicles and everyone's living it large. And then the central bank, the S&B's like, oh, negative rates, negative 75 basis points. We've got to get inflation back to 2. We've got a problem. The currency's too strong.
The United Kingdom continues to surprise. That's
all the complaints I hear about the City of London, I talk to people who work there, they wouldn't swap it for the world. Yeah, things need to improve, but I think you can make that argument
Team
everywhere.
surveillance?
I think
Team surveillance, a move to London?
As I say...